Weeks. Okay, here we go. It is time for the opening trade, Monday the 9th. We're expecting European equity markets to bounce a little bit, but after such a torrid week last week, maybe that should be expected. Similar story over in the United States. So here we go. Time for the opening trade. Let's take a look at what we're seeing this Monday morning. We are anticipating a positive picture to emerge, and right out of the gate, the FTSE 100 is on the front foot. We're expecting, as Critty says, maybe some outperformance to come through from the London market, which is interesting. Given what we're seeing in some of the commodity stocks at the moment, given the weakness we're seeing in iron ore, given the weakness we're seeing in oil, but oil coming back a little bit this morning, maybe that ripples back into the FTSE 100. Elsewhere, keep an eye on what's happening with the luxury sector. The story out of China is not of consumer strength, and that, in some ways, should again deliver a bad message coming through for those luxury stocks, particularly found in France. So the CAC 40 is only up by 0.3%. Other markets look like they're outperforming a little bit. Though I have to say, Critty, the margin looks fairly marginal this morning. We're not seeing a huge divergence amongst these European stocks. What are we seeing below the surface?
Well, below the surface, the breadth is what stands out to me, Guy. We're looking at 94 stocks in the FTSE 100 higher this morning. The others down by a very, very small margin when you look at the moves higher. And to your point, it is that commodity outperformance, which is really diverging from what you're seeing in the underlying kind of macro space as well. We've been talking about weakness in the commodities. It is not showing up in the likes of Shell, for example, this morning, or even BP, Glencore, Rio. These are your top performers, your top index contributors to the upside this morning. We've talked about ASML as well, higher by about 3%. So not only do you have a tech trade in your favor, you also have a commodities trade as well. At least that's what's going on in the FTSE 100. We're still waiting for all the kind of numbers to shake out in the broader stock 600 as well. But there, a lot of the weakness seems to be showing up in utilities, which I thought is interesting. But of course, the heavyweights seem to be on our side this morning, or at least on the side of the bulls for the broader indexes.
Okay, let's talk about some of the movers. Let's talk about some of the stocks that we're watching. We can show them on the screen in front of you. As you can see, SML Holdings is bouncing back. But it's interesting that the mining stocks, Critty, as you were mentioning, maybe doing a little bit better. Rio is up this morning, but Novo's up, Schneider's up. The AI trade appears to be on the front foot a little bit more. So miners and tech seem to be doing the heavy lifting this morning. A little weakness coming through in maybe some of those European banks. UBS, BNP Paribas, a little softer this morning in terms of the trade that we are watching. All of this obviously needs to be seen in the context of what we got Friday, the US payroll number, the market reaction to the payroll number, the market reaction as well to the Chris Waller comments, maybe signaling that 25 is the right reaction for the Fed off that data. We spoke to many people on Friday about these numbers. One you certainly wanted to have listened to is Bill Dudley, Bloomberg opinion now, but former New York Fed. Let's take a listen to what he had to say.
Officials have basically said policies should be neutral. The risks to the labor market side are equal to the risks on the inflation side, and they're a long way from neutral. But I don't think they're going to do 50. I think that a gradual approach is what they're going to pursue.
Okay, let's carry on the conversation with another voice. Jeff Hughes, Senior EMEA Market Strategist from BNY, joining me around the table this morning. 25 the right call?
25 is the right call, I think. If we look at the numbers, the breakdown, we're ready to change that to 50 had the unemployment rate been higher, subject to the usual participation issues. Then yes, but markets are not willing to price that out yet. If you look at the curve out to year end,
why did the market seem to signal Friday that 50 was what was required? Risk assets sold off when Waller sort of turns around and goes, as you have said, that 25 is the right call. Are we tiptoeing into hard landing territory? Is the consensus still soft landing?
I think the consensus is not willing to rule out a hard landing. So it depends if you're glass half full, glass half empty. That kind of an issue right now. You just can't rule anything out. We've had the gyrations in August, so to speak. I don't think people want to be caught out by that again. Hence, in terms of pricing, just in terms of insurance, you don't want to rule that out. But let data do the talking.
Jeff, it's Creedy. I'm curious about how you position for the commodity sector right now. I think the big theme this morning has been this very weak data out of the U.S., a slowdown in the U.S. consumer as well, in the U.S. economy. Not to a recessionary point, but a slowdown nonetheless. I'm curious if commodities are still the place to be, given that they were such a crucial hedge in the last couple of years.
I wouldn't take those hedges off them, actually. So this is where we may go against the recession view or even a landing view, a soft landing view, because right now, if you look at the Chinese data, especially overnight, look at the PPI and CPI, can we rule out a big push for growth in China in Q4? Now, if there's going to be any push, I prefer to see it on the consumer side, and that seems to be where the narrative is heading towards. But if that is going to be an impulse just for Q4, even on a tactical level, you can't, let's just say, afford to be all out short commodities yet either. Given where the inflation situation is, we still need to be careful. If inflation is neutral, you don't want to take away that neutrality yet. So don't go, all out underweight on commodities, even though that seems to be where market wants to head to as well.
Jeff, it sounds like you're saying there is a risk of inflation taking back higher somewhere in the world. I'm curious, is that a risk the market should be pricing in?
I think the markets are not totally pricing that out. If I look at our flow data, for example, where are some of the most long currencies? They are the high-yielding ones. A lot of LATAM commodity currencies, for example, they are seeing outflows, but outflows from a relatively long position. So I think the flow versus the stock and the fact that the stock of, let's just say, these inflation hedges still quite high. Look at gold prices, for example. That just tells us, markets are not willing to fully discount the risk of inflation being stubborn. I wouldn't say inflation surging ahead again in the same way as 2022, 2023, but you want to price in a recessionary, a hard landing narrative in commodities? Absolutely not either.
If China delivers the stimulus that maybe you're thinking it might, does gold sell off? China's been a big buyer of gold as a hedge against what is happening in the economy. Do you think gold sells off if we get a Chinese stimulus story?
I don't think it sells off. I'm willing, as much as I'm still relatively skeptical of the price action, I'm willing to concede that gold view, that asset allocation view for gold and alternatives, and so to speak, I think that's here to stay. So these correlations have broken away. Now, we half expected gold to, well, more than half expected gold to sell off when real rates in the dollar and elsewhere, they were going very high, but it didn't. So that has to be an asset reallocation story driven by the central banks. I think that's here to stay as well.
To what extent is a China devaluation story part of the solution to its current economic malaise?
So we'd be very careful with the word devaluation here, because 1%, 2% is a one-off. That's considered a large move by CNY standards. But that's just part of the course for most EM names. I do think, however, a weaker CNY must be part of the narrative. They're in deflation right now. You look at the PPI numbers, so you can't have a stronger real effective exchange rate as part of that narrative. And I think, given how the guidance we've seen through the fixings and the like, I think the PBOC acknowledges that.
Is that a reason to continue holding gold? If you're Chinese, is that risk meaning that you actually want to continue to hold on to your gold story?
I think not necessarily gold, but to continue to be overweight, let's just say real assets, ex-real estate, for example. But overall, stronger currency. Now that especially the yen has strengthened, I think that actually gives way for Asian FX in general to actually be a bit more flexible.
Jeff, what do you do with the dollar right now?
It depends on against what. So we're still willing to look at dollar yen lower. So October hiking by the BOJ, for example, I think that should be the market's base case. And even the leading candidates, for the LDP leadership election, they're not averse to further normalization as well. Euro dollar, I do not know what it's doing up here. So I've given up on my parity call for the whole year. I think 105, however, is still a viable target heading into year end. So not just euro dollar, what's Eurozone stocks doing up here? And given the awful data that we've seen, maybe politics in France, that's where you are right now, to buy some time. We're not seeing strong outflows, in the fixed income market and the sovereign bond market yet, but it's just hideous mispricing, I think, and let's see what the ECB says. Probably nothing this week on that note, but I think that's where the bulk of the adjustment needs to happen. So I think dollar holds up very well against euro, but again, I've been wrong on that all year.
Well, sometimes the contrarians take it all at the end of the day, but I'm curious how that shows up in terms of the election play. I mean, the market is still positioned long dollar. You're seeing these kind of iterations change because of Fed pricing, but in terms of the election, we're 2 months away. How do you position?
So on a structural level, if we want to look at a dollar discount, for example, or a US discount, so to speak, we still think it probably is maybe a bit more in the bond space because there's not much of a fiscal consolidation narrative in the US. And to be fair, nowhere right now, apart from New Zealand, perhaps, in developed markets. But are we talking about the dollar moving away as a reserve currency? Absolutely not, right? And if anything, some of the policies we're seeing right now, especially strong fiscal, that supports real effective exchange rate. Happy to continue playing that against euro dollar.
Let's come back to the ECB for a moment. Is the ECB looking at the rearview mirror, i.e. sticky inflation, or is it looking through the windshield at weak growth coming towards it? And where do you think it is in terms of kind of looking up and kind of trying to understand what the priority should be?
Well, I just want to look at it in broad mandate terms. They need to look at growth. And the answer is probably not relative to the Fed, right? So, yes, it is going to be sticky inflation.
But their mandate's the rearview mirror.
Well, so everything's in hindsight, and then they can move aggressively, right? But just based on the rhetoric that we've seen right now, I mean, Schnabel did mention right after the negative CPI print that we had, for August. So granted, it was headline-driven rather than core-driven, but where that inflation momentum was very high. So until services inflation comes off, I don't think the core hawkish element of the ECB is willing to react. But at the same time, I don't think services inflation does come off, because of the public spending, driven aspect of it. But at what point in the rearview mirror do you say, oh, actually, German industry, given the news we've had over the last week, perhaps needs some help? Granted, that's not the ECB's mandate. Absolutely, we need the governments and corporations to actually push forward. But some support is needed.
Jeff, a final question to you on the wage data as well. We paid so much attention to it over in the States. Is that something we're missing in the European narrative?
So I think if you look at the general narrative in Europe, it's what kind of wages are we looking at? So looking at the PMI reports, looking at the contraction, the losses in jobs within the high value added components. If the wage data is showing sticky wages and sticky inflation in low productivity jobs, then are we willing to accept stagflation, that narrative within the Eurozone? So, and I think the answer is no, we shouldn't accept that. Of course, again, that's up to the governments rather than the ECB. But just resolutely sticking to one aspect of the labour market, I think that's just being a bit too dogmatic about things, and you're missing the bigger picture.
Jeff, always a pleasure.
Thank you
so much indeed for dropping by. Jeff Yu, Senior EMEA Market Strategist, joining us from BNY. Let's take a look at the Core 6 this morning. What are we seeing in terms of the heavyweights here in Europe? And as you can see, we're actually caught something of a bid this morning, particularly in the chip space. It is bouncing back. ASML is up quite nicely. There is some strength in the luxury space. It comes from Ferrari, but look at LVMH. Weakness there. Joe's been flagging the luxury space all morning. Let's get back to him with some single stocks to watch.
So as you say, Guy, really standing out as one of the sectors that can't quite catch a break at the moment. The luxury stocks, most of these heading lower once again. LVMH down 0.4%, but bigger losses in the likes of Kering, also Burberry as well. Bear in mind, these stocks did fall around 10% last week. There are analyst downgrades on both of those stocks in terms of Kering and Burberry, both going to sell or underweight over at Barclays this morning. Hermes also getting a bit of a price target cut over at Morgan Stanley. All these concerns around earnings estimates around China hitting that sector further today. One stock that is going the other way, though, is OCI. We flagged this one earlier. This is the Dutch chemicals company offloading that unit for around $2 billion to a Canadian company. It is their methanol business. Second big sale for them in the past couple of months, up 1.8% at the moment. And then in London, the best performing stock we've got today is actually in the gambling space. We've got an unexpected trading update today out of Entain. Game on is the pun that the producers slipped in there, so appreciate that one. But that one is up around 5%. A lot of this coming from the US. They've got this partnership with MGM over in the US on American football, baseball, all of those sports. And that is boosting the company at the moment, up 5%, a decent gain for Entain this morning. In terms of miners, though, this one a little bit surprising. We've got iron ore back below $90 now, but nonetheless, we're seeing gains, as Critty was mentioning earlier, across the London mining stocks. Anglo Glencore, Rio and Antofagasta all gaining around 1% or more at the moment. A bit of a heavy sell-off last week, so it is a bit of a rebound in terms of that sector. Then some interesting analyst ratings to bring you today. Adidas, now this one is downgraded over at Barclays. Now Barclays has a separate note out on sporting goods saying that this is also going to be a weak sector. A lot of that due to the US, also China as well, similar to luxury, but more in the sporting space. We come down to equal weight on Adidas, down 2.9%. And finally, a big decliner is Ubisoft, the games company, the company that runs the Call of Duty gaming online. That one down 4.7%. Cantor Fitzgerald, a long-term buyer of the stock, no longer recommend buying, and that is a bit of a surprise for the market today. We're down 4.6%. Ubisoft declining following that Cantor Fitzgerald downgrade.
Joe, great stuff. Thank you very much indeed. Joe Easton taking us through some of the single stocks we need to be watching this Monday morning. Critty, the big picture, though, this morning, though, feels like one of concern. That the economy is slowing down. Maybe it's not slowing down that fast, but we've spoken to a number of guests already talking about the risks that Europe faces. Jeff, you was just talking about it. Some of our earlier guests, Fred Beamish, etc., were talking about how Europe is really going to struggle, particularly with what's going on in China. You're in Paris at this IPEM event. I'm sure you've had a lot of conversations already with some of the people we're going to be talking to. Are they worried? Is this an event that is going to be glass half full or glass half empty?
Glass half full, it seems. I think that's the kind of a surprising aspect, because to your point, we talk about this wall of worry on both sides of the Atlantic, and then yet, when you look at it from a positioning perspective, so many people have kind of piled in and allocated into private equity right now. That's the event that I'm going to tomorrow, where of course we're going to speak to the creme de la creme of the industry, but there's so much money in this kind of search for yield really held up in the private space. The question now is, how do you deploy it into the public markets? And to do that, you have to have the capital markets actually open up. We're starting to see a little bit more loosening in Europe than we're seeing in the States. We're seeing the leveraged loan market warm up as well, but it's still not 100% there. And for me, my main question is going to be, how long do we have all these funds wrapped up in the private space and not deployed in the public one?
Yeah, I think it's going to be a really interesting conversation. Really looking forward to some of the great guests that you're going to be talking to tomorrow. It's really, really interesting. And part of that narrative is going to be around what Draghi's going to be talking about as well. Kind of, if Europe is going to step up and deliver a more competitive approach, how does private equity fold into that? There's this whole idea that we need to see public and private money crowding in together. We're going to talk next about what his report is going to tell us about the future of Europe and its competitiveness picture. We get this long-awaited report. Is it already, though, too late? I think that is something that maybe some in Brussels are already fearing, that the political landscape has shifted significantly already. Anyway, all of that is to be discussed next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get The edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to be there. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News Presidential Debate Simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
We have an economy that doesn't grow in Europe, contrary to the U.S. In the last 2 years, the European economy grew by less than 1%, while the U.S. economy expanded close to 5%. This is a completely different picture. And inflation in Europe came down very fast, actually faster than it went up.
Mario Centeno, ECB Governing Council member, speaking at Jackson Hole, talking about Europe's dismal growth, certainly relative to the United States. Mario Draghi, set to deliver his long-awaited report on European competitiveness a little bit later on today. The former ECB boss expected to sound the alarm over the risk of the EU's economic decline. I think we've probably all been aware of that for quite some time. Really, what we're looking for here is the solution to that problem. Jamie Rush from Bloomberg Economics joins us now. We know about where we are. We know about where we should be going. The question is, what is he going to say about how we get there? What are we expecting?
Well, he's going to have a long list, right? But I mean, let's just think about the scale of the problem, though. I mean, you said that we've known for a while that the EU's been in decline. Well, 20 years ago, when Andre Sapir published a report of the same sort of title, 2003, his conclusion was that Europe is in a rut. And it's been in a rut for the next 2 decades. So we already know the problem is there's an 18% gap relative to GDP relative to the US that's emerged in that time. If that continues, the EU's place in the world is going to be dramatically reduced, right? It's not going to be a global power. And that's going to have big implications. So I think we all know the scale of the problem. Solutions generally involve money, right?
Yeah.
And
we've got so much of that.
Yeah, tons of it's just coming. But I mean, this is the real rub. So yes, we need big strategic investments in energy, in telecoms, in finance, whatever is required to try and lift the potential output of the Eurozone. The money to finance that, though, well, there is no fiscal space. We all know that. And the last chance, perhaps, for the EU to be able to drive those common challenges forwards was common debt. And that is basically dead in the water now that Macron has suffered. It's been dramatically weakened in France, and he was the big cheerleader for common debt issuance. So I think after all, when we get to the end of today, we're going to have the same sort of questions we had before, which is how we're going to finance all this stuff.
Well, Jamie, that is the crucial question. You mentioned France, but Germany as well is really struggling with this exact idea. And I'm curious, though, if that might change or if there's pockets of this 900 million euro investment that Draghi's expected to kind of encourage, if there's pockets of it that are actually viable.
I think when you think about the politics of the common debt, what's changed is that Germany was always resistant, but it appeared perhaps 6 months, a year ago, to be softening its position slightly. But I think since Macron has kind of lost power in France in any meaningful way, anyway, his kind of ability to drive forward the French agenda has been very limited. And so I think that one of the first casualties of that election loss, the European and parliamentary election loss, was common debt. So I think that there really is that very limited scope there, very limited appetite. It's not just Germany as well. There are other countries which are deeply resistant to that sort of strategy. So it comes down to, if you're not going to spend your way out of this problem, then you're going to have to make sorts of politically unpopular structural reforms, which have always been difficult for the EU to achieve. So I think that's where we are. We have the same sorts of problems, the same sort of political constraints. Some of those have actually got even worse, and so it's going to be a tough next Parliament for the EU.
Is the environment going to get worse? Let's say Trump's elected in the United States. Does it get worse? Even if Harris is elected in the United States, does it get worse? If China wants to dig itself out of the hole that it's in, presumably it needs to become more competitive globally as well and export some of its solution to the rest of the world. How much worse could it get for Europe for this?
Well, if you think about it, Europe has the problems that it's had for the past few decades. They're still there. Now it has new problems. It has a competitiveness problem because China is subsidising a lot of its production. The US is doing the same. They're throwing resources at it. The EU can't do it. It hasn't done it in the same way. And so, yeah, we have this new front, and Europe as well has also got to decide where it's going to sit in the geopolitical order. And it's much more exposed to China than the US is, so it's a much more difficult decision to get on board with what Trump might want, for example, in terms of relations with China. It's not going to be easy, so it's going to have to navigate that very difficult route on the geopolitics side, as well as tackling all the problems that it has that are legacy issues.
Jamie, is that the trick to this all? To just basically, if France and Germany had more fiscal bandwidth, the way that at least is being shown up in, say, the outperformance of the periphery of Europe, is that the trick to kind of fixing all of Europe's problem right now? Or is this still kind of late cycle dynamics that we're seeing with a recessionary hangover? Is that how to think about it?
Yeah, but I think it's an element of truth there. I think the reality is that whatever problems Europe has, they're going to take time to fix. We're not going to see it over the course of one economic cycle. We're going to see it over the course of several economic cycles, and it's about building the resilience into public spending plans, for example, so that when shocks hit, the first thing you do is not cut public investment, for example. These sorts of structural changes are going to be what's needed to preserve European spending and to keep us kind of resilient to those sorts of cyclical ups and downs.
All right, Jamie Rush from Bloomberg Economics giving us the breakdown of kind of a lot of the news that we're going to get out of Brussels as well with the Mario Draghi report, as well as Thierry Breton, making crucial comments on the EV space as well. Of course, this is the conversation right here in Paris as well as we talk about what Michel Barnier, can actually do in this role. He's an expert negotiator. He's had all that Brexit experience. Can he apply it to his own parliament that only seems more and more divided by the day? And whether or not that extension from Brussels is actually granted, does it make a difference? We're going to dive into the market file of all of that. Coming up on the program, we're going to ask Rob Arnaud from Research Affiliates where the market consensus might actually be wrong if we're talking about 25 or 50 or even a re-acceleration of inflation. What does that look like and where do you position? That conversation next. This is Bloomberg.
Seeing firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Minutes into the trade this Monday, the 9th. Let's talk about where we are. As you can see, a little bit of a bounce back. This in no way compensates for the sell-off that we saw last week, particularly towards the back end of last week in terms of risk assets. But at least we're stabilizing. I think you can probably say that as being a positive story this morning. Travel and leisure, technology, financial services, industrials are where we're seeing the gains this morning coming through. Real estate and utilities, the kind of more bond proxy end of the market, is reacting negatively, but not down by that much. 0.2% seems to be the narrative there. A little bit of outperformance maybe coming through from some of the mining stocks as well, but not that great. Certainly we were anticipating maybe from the early trade a little bit more from that. So we've seen a sell-off. We saw it last week, one of the worst weeks we've seen, certainly on either side of the Atlantic. The question is this going to be something that turns into a little bit more? Is this an opportunity that you want to be jumping onto and thinking about going forward? Well, our next guest says there will be great buying opportunities in the next couple of years. This, though, probably isn't one of them. Rob Arnott, founder and chairman of Research Affiliates, joining us around the table this morning in London. Great to see you, Rob, on this side of the... I'm good. What about the markets? How are you feeling about the markets? Are they good?
Well, I love finding asymmetries. Yep. And what we have in the landscape of the market is a view that forget hard landing, forget soft landing. There's no need for any landing because things will be just fine. Yep. Well, you've got Purchasing Managers Index in its worst quartile ever. You've got inventories in their highest quartile ever. You've got yield curve inversion, worst decile ever. You've got rate of change of cost of capital over the last 3 years, worst quartile ever. Each of these is a powerful indicator of potential slowdown. And so I love asymmetries, as I said at the beginning. The asymmetry, if you've got a robust economy, for the robust economy to become a stupendous economy, not very likely. For it to become a softer economy or a recession, not unlikely. And so while the base case of the market, continued robust growth, is not off the table, certainly very possible, the asymmetry is on the downside.
Did you think Friday we started to see some of that being reflected in asset prices? I thought Friday's session was fascinating. The payroll number was okay.
It wasn't
great, wasn't bad. Let's just park that for the moment. then we start to see Fed officials coming out and talking about the idea that maybe 50 is not necessary, which feels commensurate with maybe the data. But the market risk assets react quite negatively to that. My signal from that is that maybe portfolio managers are beginning to get concerned about that hard landing, about that downside risk. Do you think the consensus is beginning to shift towards that downside risk?
I think the consensus is shifting. One of the issues is I think the Fed, in general, central bankers all over the world have an inaccurate view of how much influence they can have. Basically, we keep hearing long and variable lags for monetary policy. Isn't that another way of saying, well, we don't really understand what the influence is, but we're going to play the game anyway? And one of the best examples in my mind is the Australia, which has been called the lucky country because it went for 30 years without a recession.
Yep.
Well, 25 of those 30 years, it had a yield curve that was always positive in real terms.
Yep.
And always positively sloping. They kept the short rate anchored fairly close to the long rate, typically 0.5% or 1% below the long rate.
Yep.
And it seems to me that that's the Fed's basic job. They claim to be data dependent. The one data point that they pay no attention to is the long bond, which is set by the market, by bid and ask of millions of investors. And if that's saying that deferring consumption for 30 years ought to be worth something south of 4%, then that tells us that the natural short rate would be somewhere around 3%. The Fed held rates at zero for far too long and then overshot on the upside. They're constantly playing the game of trying to micromanage an economy when the tangible evidence is that they don't have that much influence.
Rob, talk to us a little bit about whether that applies on the front end of the curve as well. The comment you made about the 30-year, and I ask this because we're looking at an environment when we're talking about record amount of money sitting in money market funds. And I'm curious if that movement from the market then applies to the real economy, in your view, faster than the Fed's transmission mechanism. How does that work?
Fed's transmission mechanism really affects short rates and rates that are linked to short rates, for instance, mortgages. It doesn't have that much impact on the aggregate macroeconomy, and what impact it has happens with a long and variable lag, which tacitly means they're always going to be behind the curve. When they react to economic weakness by cutting rates, they're cutting them too late. When they react to hints of inflation, where the hints of inflation are becoming stronger, they're reacting too late. Getting ahead of the curve is hard, but having a steady hand at the tiller is not that hard. I'm not sure why central bankers don't choose to have a steady hand at the tiller.
So, Rob, are you saying that perhaps this bond market is not seeing as much momentum as maybe it should? If you're talking about 3% on the front end of the curve, we still have a ways to go to get to that point. What's your bond call?
Oh, we sure do. My bond call, firstly, I'm not an expert on short-term movements in markets. I really have a long-term focus. My long-term view is that the natural yield for long bonds is about 1.5% above the rate of inflation, and the natural rate for short rates is about 0.5% to 1%. That said, the market's pricing in a very benign economic outlook, and the asymmetries would suggest that a slowdown in the coming year is relatively high odds, and that a recession is not off the table and a bear market is not off the table. I would view buying opportunities as being a ways off, but I would also say that the upcoming election creates some short-term opportunities, because we have a paper coming out shortly that shows that the market doesn't care much who wins the election. That when you have a contentious election, the markets, both sides, are terrified that the other side will win. And if both sides are terrified the other side will win, they go risk off. As the election approaches, in the closing days of the election and after the election's over, one side breathes a sigh of relief and comes back into the market. So what we find is a pretty regular pattern that in contentious elections, stocks struggle in the run-up to the election, and about a week before the election happens, begins to take off. It's about an average of a 6%, 7% move in a single month in contentious elections. So that's one thing that's interesting to play.
Short in, long out. What does a buying opportunity look like to you then?
Buying opportunities are situations where investors are in a panic, when investors are terrified, when nobody wants to.
Give me a sense of the scale. How do I spot that? Because we've had beginning of August, markets sell off. VIX spikes aggressively. Clearly, there is some nervousness in the market. Last week, equity markets sell off. We've seen one of the worst weeks in really quite some time. What kind of order of magnitude are you thinking that a sell-off is going to look like?
That's a sell-off, not even a correction. A very serious bear market creates panic, and panic is the wonderful buying opportunity. We're nowhere near that anywhere in the world.
When we're talking about anywhere in the world, though, there are places that are undervalued, and when you look at it from a equity perspective or even a bond market perspective as well, a lot of folks are making that argument on Europe. Your take on that regional divergence?
I think Europe is an attractive place to invest. It's out of favor. It's unloved. Its economy is struggling. The opportunity for the broad European stock market to do well is a very real opportunity. You buy where people don't want to buy.
Yeah. Are they buying not for... your opening line there I thought was brilliant. It's unloved. The economy is not doing very well. It's unloved because the economy is not doing well, surely.
Correct. But where are you more likely to see an economic rebound off of a robust economy or off of a soft economy?
Well,
the soft economy you can recover.
Isn't the danger that the economy gets softer?
There's always that risk. Like I said, I love asymmetries, and if the market is pricing in a particular view, then the asymmetries, Europe starts to catch up.
China looks really weak.
China, I would view as moderately attractive now. Now, 3-4 years ago, I would have said absolutely not. But President Xi has shown his true colors by every time he says, please invest in our country, then he begins to do things to make it very painful to do business in the country. So, in my view, he's an unreconstructed Maoist and can't change his stripes.
There does seem to be some contradictions in what he says. Rob, it's been great to catch up. Thank you for joining us here on this side of the Atlantic. We look forward to seeing you again very soon. Rob Arnott, founder and chairman of Research Affiliates. Thank you very much.
Thank you.
Indeed. Coming up, Apple preparing to unveil its first AI-focused phone. Can the iPhone 16 launch and the next supercycle? Is it an AI supercycle? If we need the next catalyst on the AI front, does it come from Apple? It's part of our big take today. We'll do it next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
For the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. There are not, I don't see red lights flashing. Well, there are risks. It really has been amazing to be able to get inflation down as meaningfully as we have. This is what most people would call a soft landing. Certainly may go back there. I, would welcome a visit by my Chinese counterpart.
Janet Yellen there, U.S. Treasury Secretary, speaking to Bloomberg on the sidelines of the Texas Tribune Festival in Austin. Now, it's a really fascinating conversation. We're talking then about what the red flags look like. Politics is, of course, keeping one eye on it as well. Republican presidential nominee Donald Trump leading Democratic contender Kamala Harris by 1 percentage point in a poll taken late last week. It's just the latest sign that the race is still too close to call, even less than 2 months out. Let's get more on this. Bloomberg's Kevin Whitelaw joins us this morning. Now, technically, he's the Brussels bureau chief, but this is a man who is an expert in the machinations of Washington, D.C. Kevin, your take on whether that momentum behind Kamala Harris has peaked?
So, I mean, I think it's way too early to tell. She is still leading in a lot of the other recent polls that have been taken. So I think everyone's trying to figure out whether this latest poll is just an outlier or maybe the sign of a slight subtle shift in the overall race. So I think you always have to be very careful reading too much into any single poll, particularly a national level poll. This is going to come down to a couple of swing states, and the polling in those swing states is always a little harder to parse because in the end it's going to come down to who actually shows up, who's most motivated to show up on election day. And I think we still have, believe it or not, just under 2 months left in the race, and that still can shift a little bit. One of the key inflection points we'll see is the upcoming debate between the two of them.
The headline over the weekend, Kevin, which really caught my eye, and I wonder whether it's going to come up in the upcoming debate, is Trump's attitude towards tariffs. And he's now kind of drawing a line between his tariff policy and the dollar. Don't use the dollar, you get 100% tariffs. Honestly, how seriously do I need to take this?
Well, I think you always have to take those kinds of policy descriptions from him seriously, but not necessarily literally. So he does love the idea of tariffs. He views them as something that isn't really a tax on Americans, even though obviously consumers end up picking up the tab in most of these cases. But he does want to see a tougher trade policy, and that's something that sort of resonates with a lot of his group. So I think you'd see something. Would it be exactly 100%? How would it work? I think that is going to take a long time to actually sort out. We don't really have any details. It's not like there's, sort of policy papers on his website that sort of spell all of that out. But I do think that it does show you that if he does win, whether it's Europe, whether it's China, like it's going to be a much more aggressive trade policy than we've seen.
Well, I wonder if it's something that comes up in his debate showdown with Kamala Harris. I think that's tomorrow night in the States. And I'm curious how big of that might actually change the momentum either in his favor or against him. Is this the game-changing moment pre-election?
I mean, you know, the last one certainly was in ways none of us possibly imagined. I think this particular debate is super important. I think one of the interesting elements that you saw, and it showed up in the New York Times poll, is that people are still looking for more information on Kamala Harris, and so this is both an opportunity for her to continue to introduce herself to more Americans and to sell herself, but obviously there's a lot of risk for her in terms of you know, like making sure that she can actually stand up to Trump and his attacks. So, you know, Trump has his own moments of peril, potential peril in this too. He has a history sometimes of bristling when he's confronted by strong women. So I do think that it is a moment where both candidates will go in with a game plan, and it's really unclear whether either of them are going to be able to stick to it.
Kevin, final quick question. You're in Brussels, so I just want to ask you this. Is Brussels agog with anticipation for the Draghi report? Are we all really excited about what is going to happen? How much of this is really going to be a game changer?
Well, I do think that the Draghi report is an important moment in Brussels where the Commission and the European Union more largely are going to be trying to grapple with what is becoming an increasingly clear and stark problem for them, that European industry is having more and more trouble competing with U.S. and Chinese companies, particularly when it comes to just productivity and just overall investment and startups saddled by high energy prices. And so you are seeing an effort to try to jumpstart this conversation to make some really serious changes, both in sort of the overall investment level in some of these industries, but also with just some additional agility to begin to sort of set itself up better for the future.
Kevin, great stuff. Thanks very much indeed. It's going to be an interesting week for Europe and the United States. Kevin Whitelaw joining us on both. I think the Draghi report has a number of issues that I think are really going to be important for Europe. Europe is much more exposed to the China trade. Some US companies are, though, directly exposed to that trade as well, and Apple is one. So it's going to be really interesting to see what we get from Apple. It could also be affected by the tariff trade if Trump were to become president. The global tech giant is a little later on today going to be unveiling its iPhone 16. In theory, this is the first AI-focused smartphone. How focused it's going to be, I think, remains a big question. Apple, the focus of our big take today, Bloomberg's big take, looks at some of the importance around this company and how it's risen to become the world's most valuable business. Matt Bloxham, senior technology analyst at Bloomberg Intelligence, sitting alongside me to talk about all of this. We've been waiting for something new for Apple to justify its status. Is the iPhone 16 with AI attached going to be that moment?
I don't think it's going to be the moment, but it may be the start of a moment. Right. Obviously, we had a kind of precursor to that with the announcement of Apple Intelligence back in June. I think since then we've heard that actually some of these features is going to come later and later than expected. So I think what we're going to see later today is them very much put Apple Intelligence at the heart of what this device is. But actually, you know, it's going to be... You just have to wait a few months at least until this stuff kind of comes out. But I think that is going to give some clarity because there's been lots and lots of talk about which features that you can see today, which ones are coming when. So I think we should get at least some clarity about this today. So I think around that, the device itself isn't really going to look very different from the iPhone 15. There's going to be a couple of extra buttons. We'll have to see whether the pricing stays the same or they try to kind of get a little bit more out of people from it. But I mean, it's 50% of Apple's revenue, so massively important to them, and it's really the kind of anchor for all the service revenue, which is another 25% of their business. So it's a really kind of critical device for them to get right.
Matt, just hours after Apple unveils their first kind of Gen AI product or AI features, as you point out, you have Huawei doing something very, very similar. How much of that is a threat? How much of that was by design? Your thoughts?
Yeah, I don't really see it as that much of a threat because you've got two camps. You've got the Android world, which Huawei's in, and then you've got the Apple ecosystem. And if you look at the kind of market share between the two is kind of fairly stable, and if anything, in some markets, the Apple ecosystem is kind of gaining a bit of inroads into the Android ecosystem. So, you don't see, you're not going to see a whole bunch of Apple users suddenly switch to a Huawei device on the back of their latest update.
So Europe is going to have to wait for the AI stuff because of the regulation over here.
Yeah.
Can Apple deliver AI to China? Given the importance of the Chinese market, are we starting to see the AI marketplace being segregated? You've got the United States, you've got Europe, you've got China.
Potentially, yes. I mean, that's a massive question. Obviously, Europe's a big question about how they're going to be able to deliver it here too. And there's all sorts of other kind of regulations and legislation and antitrust issues going on too. So, I think the AI environment does create lots more questions about how accessible some of these markets are to non-Chinese.
Does that reduce the value of Apple? If you can't sell, if the next iteration is to sell AI products, AI smartphones, etc., etc., is Apple's upside limited by its capacity if it can't deliver it to two of its key markets?
I mean, obviously, China is a key market, but there are lots of other key markets for Apple, and obviously India has been a market that for many years people have been looking at as a big opportunity for Apple, and we've seen them, change things about the production facilities to kind of serve that market more. So it certainly puts more pressure on Apple to find ways to kind of plug that gap if we do get one, but I don't think in itself it's a big worry.
Matt, great to see you. Thanks as ever for stopping by. Matt Broadson joining us from Bloomberg Intelligence. That's going to be one of the big events still going to be watching. That launch is going to be one that's going to start our week, but it's a really big week. You've got an EU tech ruling coming up. That regulatory story is going to be absolutely fascinating. But this week is going to be dominated by a number of different events. You've got the Draghi event coming up a little bit later today. You've got this US presidential debate, which we're going to be watching very, very carefully Tuesday into Wednesday. We've got an ECB meeting coming up. You've got industrial data. So you've got industrial manufacturing data we're going to be watching out of the UK. Keep an eye on the wage data out of the UK as well today. I think that's going to be really important. The ECB, I think, is going to be fascinating. What kind of language are we going to get from Draghi? I think is going to, I'm getting behind myself. I should be getting ahead of myself. What are we going to get from Lagarde in terms of what she talks about? Is she worried about the future, or is she worried about the past? Is she worried about growth, or is she worried about inflation? And we've got UMISH data coming out on Friday. Critty, you've got a big day coming up as well tomorrow. Talk us through who you're going to be talking to and what the tone of those conversations is going to be.
Well, the tone from a macro perspective seems to be very doom and gloom, but the tone in private equity is the exact opposite. And the argument here is that private equity operates at a little bit of a lag. So you can think about it two ways. You could think about it as the red on the screen in the public markets may not show up just yet, or it's simply delayed. And this is interesting because you're seeing a record amount of money in these markets, a record amount that really hasn't been deployed in the public markets because they're stuck in the private one. So we're going to talk to the top folks over at Apollo, KKR, among many others in Europe about when those capital market activities, when those flows come back in the public markets, and whether this is one area where Europe is actually ahead of the game. So I'm really excited about those conversations.
Chrissy in Paris. That sounds like a show, doesn't it? Maybe somebody's thought of that one beforehand.
I'm ready for Critty and Tahiti. I think that's the one I'm going to try to pitch.
That sounds also quite excellent as well. Yeah, maybe that could be the next. We'll all go on that field trip, I think. What we got coming up next, because Critty and I are pretty much done. Francine's going to take over. She's going to be speaking to Jeff Curry, Chief Strategy Officer for Energy Pathways at Carlyle. Always interesting to see what he has to say. Big down week last week for energy prices. A little bit of a bounce here this morning. In terms of what we're watching this morning from an equity point of view, as I say, a little bit of a bounce back. Does this feel risk on? Doesn't quite feel like risk on yet, given the context of what we saw last week. Anyway, Francine has got a great lineup on her show. I will hand you over to her. Really interesting to hear what Jeff Curry has to say about the energy space. That's next. This is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Stocks stage a partial recovery after last week's sell-off as cooling U.S. jobs data actually adds to fears that the Fed is behind the curve on rate cuts. Deflation risks grow in China as signs of economic weakness mount. Consumers' prices rise less than expected as weak demand threatens Beijing's annual growth target. Plus, Donald Trump threatens a 100% tariff on countries that turn away from the dollar, while Trump now leads Kamala Harris by a point in new national polls. Now, also coming up, we'll discuss the outlook for commodities and the wider energy sector with Carlyle Energy Pathways Chief Strategy Officer Jeff Curry. But first thing is first, let's look at the European markets map and really try to figure out what the week that will bring means for a lot of these stocks. We have ECB expected to cut on Thursday, and then, of course, it's the Fed next week, so a lot of positioning and repositioning ahead of that. We're seeing a bit of a lift after the downfall that we saw on Friday. The DAX, the CAC 40, the FTSE MIB, and the FTSE here in the UK gaining between 6 and 0.8%. The most interesting bit is what's happening with the S&P futures, also gaining by a similar amount. Again, there were concerns about especially the labor market and Friday, and there's now the contentious question on whether the Fed actually front loads a lot of the cuts or actually goes very carefully cut by cut into the new year. The 10-year 3.7418, you can see euro dollar, this is a story of tariffs and Trump, and then we look at renminbi 71167. So that's your markets. We have, of course, a lot going on in general. For the conversations that matter, the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, investors definitely split on whether the Fed will go for a jumbo-sized rate cut later this month after the latest U.S. payrolls report. Well, we've heard from the Fed's Chris Waller and U.S. Treasury Secretary Janet Yellen.
Data we have received in the past 3 days indicates to me that the labor market is continuing to soften but not deteriorate. And this judgment is important for our upcoming decision on monetary policy. With inflation and employment near our longer-run goals and the labor market moderating, it is likely that a series of reductions will be appropriate.
When you think about what will drive it, the pace of consumer spending That's important, and that remains quite solid. We're not seeing layoffs. We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs. Unemployment insurance claims remain at very low levels. So I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
Well, let's get straight to Nanette Heshna-Feider, but Chief Investment Officer for EMEA and, of course, Head of Investment Strategy, Sustainability and Research at Lombard Odier, joining us from Zurich. Nanette, great to have you on the program. As always, it's a huge week for the markets. We had that repricing because of Fed expectations. We're expecting the ECB. What are you most excited about in the markets right now?
I think it will be all about the 25 basis points versus 50 basis points rate cut by the Federal Reserve. I think this is really the focus now. Inflation is well on track to the long-term objectives, 10-year U.S. break-even inflation rate at 2%. So I think the market can fully concentrate on what is the real economy doing and on the Fed doing perhaps an insurance cut here to get ahead of the curve again.
So, Nanette, I guess the question which will be contentious is do they front load to the cuts or do they actually go step by step? What's your take?
I think they don't have much to lose to actually make a bigger cut in September with a 50 basis points. First of all, there has been shifting expectations in this area. Certainly, the market would not be overly surprised, and it's a great possibility for them just to initiate an insurance against whatever softer data are coming that the Fed is already focused on it. So all those things are standing really quite close in this 25 scenario versus 50, but we are leaning now towards a 50 basis points cut, front loading in September, followed by more 0.25% cuts in November and December.
Nanette, what does it, when you look at China and some of the concerns, of course, of deflation, we're seeing iron ore also weakening. Do you worry about a global recession? And again, what does that mean for your portfolio positioning?
No, at this moment, we are still of the view that a recession has a low likelihood. Yes, we are completely in a soft landing scenario. Manufacturing has been very soft for the whole of the year, and China is playing a very big role in manufacturing still. So altogether, it's an environment where we are seeing central banks able to provide the support, the backstop for the global economy not to enter recession. These cuts in interest rates by developed market banks are going to be helpful to stabilize the real economy, and that should provide still for a good balanced strategy, Francine, by way of investment. It provides a good backdrop for bonds where bond prices can continue to stay stable as central banks are cutting interest rates and inflation is stable. And then as far as valuation of equities are concerned, of course, rate cuts are helpful as well. So a good balanced strategy that is mixing fixed income, equities, but not forgetting the alternative investments that have played the stabilizing, diversifying role all along this year.
So, Nanette, when you look at, for example, the falling oil price, what does that mean for the global economy? Is it a kind of stimulus for it, or do you worry that it's a sign of uglier things to come?
As far as commodities are concerned, for sure, there is always this aspect of cyclical commodities and those metals, for example, that participate in manufacturing value chains are signaling to us that there is a softer economic outlook that is unfolding. But on the other hand, commodities are also responsive to geopolitical risks, are also very much, when you think about precious metals, an area of safe haven. I think commodities right now are playing an integral part of allocations for sure. We have been very positive on precious metals and gold in particular in the current context. It is benefiting from the cyclical setup that I have described, inflation that is stable and rate cuts. It is also a safe haven in case of risks flaming up again. And it's a perfect diversifier, not being very correlated with other assets in typical asset allocation.
Nanette, we also had on Saturday this pitch from Donald Trump that basically said if you abandon the dollar, if you hurt the dollar, watch out, I'm putting tariffs by 100% on you. I mean, this is another phase or another way of looking at what he could do. How do you, I guess, differentiate the noise from the actual policy when it comes to the U.S. economy?
I think generally speaking, policy action and actually political action has taken much more of a center stage, Francine. In the past, it's been all about the economy, all about central bankers. Well, today, in today's world, it's all about politics. And so what I am taking out of it is for sure some uncertainty about inflation in function of the U.S. election outcome. There are two different scenarios that we are currently able to draw, depending on whether it is Kamala Harris or Donald Trump that are getting into the White House. And that is going to imply also different paths in terms of how rapid and how much the Federal Reserve can do, with all the implications for the dollar for cyclical reasons. So I think that right now we all have to learn to factor in much more political influence that is leading to more uncertainty on inflation, and therefore, in terms of the positioning that investors have to do, there is also risk scenarios that have to play a much bigger role. As far as the dollar and the de-dollarization is concerned in those comments you referred to from Donald Trump, I think the move towards having different alternatives from a number of countries in the emerging markets, also in central banks, in terms of their asset allocations, are probably going to see a decline of U.S. dollar assets. This is not the first time that we had such declines in shares of reserves, central bank reserves of dollar assets. You can go back to previous periods where there has been fiscal policy, current account deficits in the U.S. that have exactly led to the same thing. So I think that in the end, whether it's central banks or investors, when they think about the U.S. dollar and the outlook for it, will be very sensitive to the sustainability of economic policy in the U.S.
Nanette, thank you, as always, for joining us. Nanette Heshna-Feider from Lombard ODA. Now, coming up, don't miss our conversation on commodities and the energy transition with Jeff Curry, Chief Strategy Officer for Energy Pathways at Carlyle. More on that next, and this is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Iron ore futures briefly sank below $90 a ton earlier as China growth concerns weigh heavily on the market. Now, to talk more about the outlook for commodities, Jeff Curry, Chief Strategy Officer at Energy Pathways at Carlyle. Jeff, as always, thank you so much for joining us. I have 1,001 question on commodities. Oil also a little bit down. If you look at the falling price of oil and other commodities, what does that mean for the global economy?
Well, it's clearly positive. The question is, what is this fall in prices signaling? I want to emphasize in oil, the fundamental physical picture is still intact. Inventories are drawing. You saw it in last week's data, the satellite data, they're drawing. You're in a deficit. Forward curve is backwardated. The financial market, however, is where the bearishness is, and it's trading the forward outlook, not today. So we look at this decline in prices, it's telling you nothing about the current situation, but rather what it's telling you about is the future situation. And they expect weakness in China to dominate. I'm not trying to say China's okay today. It's weak, but it's not impacting the oil market that significantly right now. The second thing is OPEC, spare capacity, and the third is U.S. shale. Those are the three factors that are driving the weakness today. I give credence to the Chinese concern, but the other two, I think they're overblown.
So, Jeff, this is basically a sign of mounting weakness in the global economy. It's not some sort of stimulus that could lift up the economy.
Well, I think, it's not that large of a pullback. Let's say, low 80s to low 70s. It helps at the margin, but it's not significant. I think ultimately what it's reflecting across the board is concerns around China. And I want to emphasize, yes, China is weak right now, but the market response is overblown. So let's talk a little bit about China and what's going on there. Let's start with the energy market. The year-over-year declines have a lot to do with base effects. If you recall, last year, China came roaring out of COVID. You had a lot of restocking going on. That pushed the demand level up substantially during third quarter last year. This time around, you have destocking going on, and the level is going down. So the gap, the year-over-year declines are quite large, 500,000 barrels per day, and that's what has the market worried. When we think about that decline, 1/3 of it is associated with energy transition, like trucks shifting out of diesel into LNG. This 2/3 of it is associated with economic weakness. And that's the one I think people are concerned about and focused on. We think it's temporary as you go into fourth quarter, and we expect it to see a lot of it is base effects. It just gets easier on the comp. But the monthly data is showing a turn. I also want to point out another thing that's driving that weakness is the rate differential between the U.S. and China. China's been cutting. U.S. has stayed at the very high levels. That pulls capital out. The last quarter's capital outflow was a minus 14.8 billion. That's a very large number for China. And I always said the best way to get around capital controls is use commodities to move them out.
But, Jeff, so first of all, have you written off China as a solid, demand center for oil? And because of the transition, there must be others that actually benefit, like copper and iron ore. And when do you see that picking up significantly?
I think, first of all, when we think about China, to answer that, China's much smaller in the oil market than it is in the metals market. It's much larger. And strong growth out of India is offsetting some of this weakness in China when you look at it at a global basis. But turning to the metals market, what had been going on previously is that we had a weak property market, and that has remained weak now for about 2.5 years, being offset by strength in manufacturing driven by green CapEx goods. And as long as the property market could stabilize, the strength in the green CapEx goods offsets that weakness in the property market. What has happened recently is concerns around tariffs hitting those green CapEx goods and slowing it down, while the property market has started to sink again, not offsetting it. And that's what's created the concerns, particularly in copper. By the way, I want to give you some numbers on green CapEx capacity. The auto market in China is about a 25 million unit market. The capacity to produce cars in China is 50 million. So you see the concerns about, the exports of EVs, lithium batteries and other green CapEx goods. But I think the key point there is that balancing act between the property market that's hurting copper, and then you have the offset being the green CapEx. The question right now is, can they stabilize that property market?
Jeff, are you still confident about a price spike for oil after this unwinds?
Well, the question is, the spike was under a condition if you saw a disorderly unwind of all of these shorts. Here in APEC, here in Singapore, the willingness of anybody to short, they go, let's go short this market because it's bearish forward fundamentals. But the reality, everybody puts the caveat warning sign. This market is at a record short, shortest on record, which means it's very dangerous to short. And the point here is we have destocked inventories because of high interest rate. The capital cost is too high to hold the inventory, so you run it down. You think about financial positions as being working inventory in the financial market. High interest rates, we run down those positions to very low levels. What the point I'd argue is interest rates start to decline. Most likely you'll get an orderly unwind of those shorts, and we'll have some restocking going on. The spike is something happens that shakes everything out of the market, that you get that disorderly unwind of all that shorts. That's where you could get the spike. So I know it's not like a mainline forecast. It's just saying, hey, we got to be very careful with this record level of shorts in the oil market today.
Yeah. But Jeff, do you see record amount of shorts in equities overall? And what does that mean, for example, for futures to iron ore, or how we look at the world economy?
Well, when we look at the equities, they've come off very, very sharply. And, the question you have to ask is, are they going to cut dividends that they pay to the investor, or are they going to cut CapEx? They're most likely going to cut CapEx before they cut the dividend, because they have to continue to attract investors into the space, which means this pullback, even though it's not physical yet, it is starting to potentially impact CapEx budgets, which will again put more pressure on that forward. Because remember, the bull thesis that we're putting forth is really driven by underinvestment in the need for large-scale capital investment to make the energy transition happen.
Jeff, in one answer, what's the commodity that's actually being sold off unfairly? Where do you see the most opportunity?
The most opportunity goes back to gold. It's a winner across the board here. Gold is is what the Chinese property owners are buying as a hedge against the weakness in their property market. Gold does well with rate cuts that are likely to come up. Gold does well when you have economic uncertainty. So it's kind of the catch-all of all these markets. And then I think when we look at longer term, copper is the one that has the stronger fundamentals further out. Yep. Gold is going to be, or oil has a lot of volatility.
Jeff, thank you so much. You'll have to come to the studio next time. Jeff Curry, Chief Strategy Officer at Energy Pathways at Carlyle.
Great.
Much more to come. This is Bloomberg.
is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Boeing and its largest union say they've reached a deal to potentially avoid a strike at the troubled U.S. aircraft maker. Now, the offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. You can see Boeing pre-market 2.9% higher. And we're also bringing you live pictures of Bloomberg's Spotlight on ASEAN business event taking place in Singapore. You can continue watching that on Live Go. Bill Winters there with our Haslinda Amin. This is Bloomberg. In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordourn only on Bloomberg. Context changes everything.
Good morning, everyone. Welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Stocks stage a partial recovery after last week's sell-off as cooling U.S. jobs data adds to fears that the Fed is behind the curve on rate cuts. Deflation risks grow in China. Signs of economic weakness mount. Consumer prices rise less than expected as weak demand threatens Beijing's annual growth target. Plus, Donald Trump threatens a 100% tariff on countries that turn away from dollar, while Trump now leads Kamala Harris by a point in a new national poll. So in other news, Mario Draghi is set to deliver his long-awaited report on European competitiveness in the next half an hour. Now, the former ECB chief is expected to sound the alarm over the risk of the EU's economic decline. Well, joining us now is Jamie Rush from Bloomberg Economics. So, Jamie, thank you so much for joining us. What exactly are you expecting him to say?
Well, I mean, I think he's going to. There's lots of things for him to say. I mean, there's lots of problems, right?
Yeah.
So, I mean, if you think about the risks, well, actually, they're actually a fact of life. We've seen the EU economy has grown much more slowly than the American economy over the past 2 decades. And if you think back to 2003, when the last competitiveness report was published, the conclusion was that Europe was in a rut. Europe's still in a rut. So I think we have. The question is going to be around the solutions that he proposes and whether they're feasible. And I think there's probably like 2 groups of solutions, right? There's things that cost money, and we could talk about those, but they're probably not really a goer because there's no money. And then there's things that don't cost money, like, say, completing the capital markets union, completing the banking union, things that could actually help. But they cost something that's even more precious than money. They cost political capital. And there isn't any of that either. So I think we're serious constraints both on the fiscal side, also on the political side, because some of the champions of EU integration, like Macron, have waned.
So, Jay, I want to ask you, what's the point of the report? It kind of lays out all the troubles that Europe has, but if there's no willingness, if there's no money to actually get anything done, does it actually, I guess, kickstart anything?
Well, I think it's going to come up with some useful ideas. I don't think that every single recommendation in the Draghi report is going to be followed, because it's just, as I said, the constraints are just too big, too binding. But little inroads can be made in different places, right? And so I think if there's anything that's taken from some of this report, then I think it's going to be nudging Europe further down the road towards prosperity. But we're not looking at a wholesale change here, and that's going to be a problem.
Jane, we're also expecting, of course, the ECB on Thursday. This is a week before the Fed. What's changed since their last cut in June?
Well, I mean, quite a lot, really. So, I mean, first of all, the Fed has obviously decided that now is the time.
Yep.
And so this obviously makes a lot more space for the ECB to cut without worrying about the exchange rate, without worrying about the going it alone effect on the all important issues. But the other thing that's changed is that there's just much more evidence now of widespread sort of deflation or disinflation. So we got the wages, like compensation of employees data last week. That dropped to 4.3% on the year. ECB was forecasting 5.1% as recently as June. So that's like actually a big undershoot in wage growth. So they can feel pretty confident that domestic price pressure is falling away. Also, profits data, they're showing a bit of an easing in profit margins as well. So all good news. All should cement a cut. The question really is whether how fast they're going to cut thereafter, and the jury's still out.
And Jamie, when do we start modeling? I mean, we had this, I guess, campaigning pledge from Donald Trump on Saturday saying that tariffs will be at 100% if you try and challenge the dollar. What does that mean for Europe?
Well, there are just big questions around trade policy, right, for Europe. I mean, Europe is now trying to deal with its legacy issues as well as confronting the geopolitical context it's now in. So it's got a doubly hard challenge. Tariffs, I mean, the main thing is that Europe is not in a position to follow the US on tariffs because it's so much more exposed to China. And so we're going to have this like political conflict or geopolitical conflict that's going to continue, and Europe's going to have to navigate that path, and it's going to be hard.
Jamie, thanks so much. Jamie Rush there from Bloomberg Economics. Meanwhile, the French government has requested an extension from the European Commission to the deadline for submitting its plan to reduce the public deficit. Well, the finance ministry told Bloomberg it asked for additional time to ensure consistency with its 2025 finance bill without saying what the new proposed deadline would be. Venezuelan opposition leader Edmundo Gonzalez has been granted political asylum in Spain after fleeing his homeland to avoid arrest. Well, it comes a month after the opposition presented voting records they say prove Gonzalez won the July presidential election. And 2 NATO members reported incidents involving Russian drones over the weekend as Moscow steps up its missile and drone barrages against Ukraine. Latvia's president said a Russian military drone crashed in the eastern part of the country on Saturday. Meanwhile, Romania's foreign minister urged Russia to abide by international rule after a drone violated its airspace over the weekend. Coming up, the UK needs some huge investment to get back on track. That's the finding of a new report. We'll be speaking to Nigel Wilson, who chairs a group that authored the report. He's also former Legal and General Chief Executive. That's next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Welcome back, everyone. Now, new report says the UK needs around £1 trillion of investments over the next decade in order to boost growth. Now, according to the Capital Markets Industry Task Force, an extra £100 billion of fresh investments every year would put the country on track to achieve 3% annual growth. Now, the report's chair, Nigel Wilson, is with us now. He's also chairman of the Canary Wharf Group and former chief executive of Legal and General. Nigel, as always, thank you so much for giving us a little bit of your busy schedule. So first of all, 3% target. Is there a gold spot with the 3% growth target?
Yeah, it's consistent. I mean, we're 100 billion is about 3% of GDP, so that would get that instant boost to GDP as a consequence of that, and it puts us back in the middle of the pack. We've been bottom of the division for G7 in most years for the last 20 years, and we're at 17 to 18% when we need to be at 21, 22%, and 3% is a good, easy to deliver number on both the supply side, the demand side, and on the relative side.
So why have we been bottom of the pack? Is it political will? Is it the fact that actually it was just a struggle to attract investment? Is it that the story wasn't cohesive enough?
No, I think we've just underinvested. And if I just take a typical industry like water, do we think we've overinvested? We've underinvested, so we've got to catch up, and whether that's 8 billion or 10 billion pounds per annum. That's, I've been on housing and talked about that a lot. Energy, we know we're behind on that. And we have great industries like VC and private equity, to be honest. We probably have the best private equity industry in the world, alongside the Americans. And we're second with VC. We have more VC money here, and that's grown by a factor of 10 in the last 10 years. But I think it can grow again over the next 10 years, because we have the best fintech firms in the world. They're private at the moment, but eventually they'll become public, and they need more capital. They can invest that capital because they're great firms. A lot of that capital now comes from America, but we can have more of it from the UK.
So what's in your report? And actually, on water, is there something like Thames Water that actually makes investors really scared about what they'll find in the UK? This is like a big scandal.
Well, they are scandals, but they're because of underinvestment over a long period of time, and they eventually catch up on you. I've talked before about the Gordon Brown's dividend tax in 1997. Roll forward 25 years, amount of equities we hold 50% at the start of the process, the finish 4%. That made a huge contribution towards these things. But any individual year, it looks like a difficult decision and doesn't happen as a consequence of that. But we've got $6 trillion of capital that could be invested. A lot of that's held, and way too much of it's in gilts and in cash. We need to have that productive investment coming from all of that. And over the long term, that should lead to great results, because, if you remember, from 1955 to 2005, the UK's productivity growth, real wage growth, real per capita income growth was the same as America. In fact, our stock exchange outperformed America for 50 years.
Nigel, it's not easy, right? Taking money out of gilts and putting it's just a riskier strategy.
It's not a riskier strategy. That's the myth.
It has to be a riskier strategy.
No, it isn't a riskier strategy, because the 10 and 20-year VAR is much less. The risk return over 20 years in the UK and indeed in the US, over any 20-year period, and you're making those investments for 20 years, you have had a positive real return, and a substantial one. Not one of those years is it negative. In gilts or cash, for a large part, you get negative returns on a real.
But election cycles are not over 20 years.
No, that is part of the problem. But that's the theoretical horizon is the 20 years. So you should be looking at 20-year variances, not one year or 6 months or whatever. And it's, Buffett's done this for a very long period, taking very long-term views, invested for a very long period of time, and that's delivers a much better outcome for consumers.
Is this government ready to spend political capital on this?
They say they are, but they have to deliver on that. And I think certainly the meetings I've had in the past with Keir and Rachel and Johnny and others have been very pro-business. But if you look that's happened to AstraZeneca, they've had one plant, they couldn't get finance in the UK, they've done it in Ireland. The next one they're struggling over. Shell have just been told that they can't invest in a North Sea oil project, and they're our two biggest companies. And we should be looking at them and treasuring them and trying to help them become even more successful going forward.
Global Investment Summit is October 14th, and we've already heard that a lot of Wall Street giants who have the firepower to put money in this country can't make it. Does that count for something? When you speak to chief executives around the world, are they willing to put money in the UK?
No, they're willing to put money in the UK, and look at Microsoft, look at Google, and look at these other places. However, it's a very odd time to have the Global Investment Summit 2 weeks before the budget, and personally, I would put it back until early in the new year. It's one of those diary slots that's not in people's diaries, and so if you want to put it in people's diaries, you want to create a real positive message in the UK, have the summit later and get a really good narrative, because people are going to be really interested. What's in the budget? What tax changes you want, and the whole conference will be. Oh, look at so-and-so, a lot of American executives won't come, and a lot of global investors, they won't come. And so...
Nigel, how difficult do you think this budget is?
What?
How difficult do you think this budget is?
I don't think it's difficult at all. In fact, I think the UK economy is growing, reasonably well. Unemployment's, at a very low level. Inflation's come down to nothing. We've got this huge investment gap, and that's what we should be focusing on, not the negative stuff, that there's some black hole or whatever. Let's talk about the fact that we're fighting fit and becoming increasingly fighting fit. London's still a great city. Look at this wonderful place that you have here. And there's huge investment opportunities right now everywhere in the UK. But you be the people who open the doors, the politicians. We don't need any more, government banks and this, that, and the other. We need the big investors in the world to come to the UK to invest and deliver growth for our people.
But, Nigel, so the Prime Minister was definitely downplaying the economy, which is quite strong, stronger than expected, and certainly stronger than a lot of other G7 countries.
Yeah.
Why is he downplaying it?
I don't know why he's downplaying.
But is it politics to put the blame, or could there be something game-changing in the budget that he's trying to explain today?
Not that I'm aware of. So, but certainly my pre-election discussions with them. In fact, we hosted 2 meetings when I was at Legal & General that Keir and I had engaged on, one on infrastructure and one on housing, where the chairman or the chief executives of all of the firms that we invited came. So 100% attendance from even the big global players who came, because they wanted to listen to the narrative, tell their story around it. And there was, I would say, excellent active listening from the Labour representatives pre the election. Now they have to deliver on that post the election and be open to business to the big providers of capital and the biggest and most successful companies, plus all our growth companies. Our growth companies are to be treasured because we have some of the best growth companies in the world, in the UK, in growth areas.
But they may not IPO here. They may IPO elsewhere because the capital markets pool is bigger.
And that's part of our job, and part of is how do we make it easy for these people to, and reversing the outflows into active equity for the last 20-25 years in the UK, and making it a much more attractive place to invest. And I'm going to be a man on a mission on this for quite some time, because I think it'll take a lot of time to persuade people. This is an Indiana Jones moment. Actually, we've got to throw out the stones, we've got to walk across, we've got to make ourselves a growth economy, because we've had no growth in real wages, real productivity, or real GDP since the financial crisis. And so we've fallen massively behind America. It's no good comparing ourselves with Europe. They're already recognizing they've got a bigger problem.
Nigel, would you force, for example, pension funds, maybe even local authorities, to put pension money in UK companies?
Yeah, I would be I call it soft compulsion. but
does anything get done with soft?
They've got 38% of their assets invested in global equity in the MSCI. We managed a lot of those assets in my previous life, so I know where they are. I know where they are and what they did with it. And the MSCI is going to look good on any backward-looking metric, because it's 70% of it's the US. 2 companies, Apple and Microsoft, have a bigger weighting in the MSCI than the whole of the FTSE 100. And that tells you, you've got to start thinking bigger and bolder. Yeah. There's one message to the Labour Party.
But Apple would have given you better returns.
Apple did give better returns.
So that's why you invest in that and maybe not the FTSE.
That's what's happened for 25 years, because, if you look at since the financial crisis, the US index, US has delivered 8.4% real growth per annum, and we've done 2.2. The previous 50 years, we were 6.6, and America was 6.2. So we were doing better, now we're doing worse. Doing the same stuff isn't going to deliver anything else different from what we've done in the past. Discouraging investors from coming to our global investment is not a great idea.
And Labour understand this?
They're beginning to get it, because actually people were looking for hope after the election, not doom and gloom.
Nigel, as always, thank you so much for joining us. What a good conversation. Nigel Wilson, chair of the Capital Markets of Tomorrow report. Now, coming up, Apple. We're just talking about Apple. Apple is set to unveil its new AI-focused iPhone 16, which it hopes will be a smarter phone than the rest. We'll give you all of the details next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back, everyone. Now, in a moment, we'll talk Apple with Matt Bloxham from Bloomberg Intelligence. But first, let's get the latest on U.S. politics. And Donald Trump has pledged to make it too costly for countries to shift away from using the U.S. dollar, adding a new pillar to his tariff platform. Now, joining us now is Bloomberg's EMEA news editor, Rosalind Matheson. So, Ros, thank you for joining us. I mean, it was a little bit of a wild card when he said that on Saturday. What countries might Trump be targeting on these tariffs?
Well, it seems he's really aiming this at the countries that are being in the BRICS grouping, which is obviously China, as well as India and others, and this grouping which is increasingly expanding to bring in new members and trying to establish itself as a slight alternative power grouping in a way to the Western-led structure from the US. And so what you have is an expanding power base with BRICS, countries in the Middle East and Africa, elsewhere, possibly Southeast Asia joining, and the idea of can you then move away from the US dollar as a key currency for trading? Can you use the yuan more, for example, which is something China has long wanted to do? And so this is really about saying to those countries, I'm going to compel you to continue to try and use the US dollar because otherwise I'm going to put 100% tariffs on your products.
But Ross, this seems dangerous because already, this big move got accelerated when there was, the sanctions against Russia, where suddenly a lot of actors said, well, we don't want that to happen to us. So by, threatening, is it counterproductive?
Well, obviously, if you take a trade action against a country, that country will probably take a trade action back to you. We've seen that with China as well. So you've got US probes about China on the dumping side, and then China retaliates against Europe with a counter probe or counter tariff. Similarly, again, China and Canada recently. So if you take an action like that, 100% tariffs, even if that's feasible from the outset, you're going to get a response. So all you're doing is creating a further environment where we're in a global trade war at some point. And what does that mean for the US in turn? Because you can say that you're going to do that on all your goods coming in, but what does that do to your goods going out? What does that do to the global trading system as we know it? And what does it do to the dollar in turn? Does it actually do for the dollar what Donald Trump would hope it would do?
And Roz, what do the polls tell us between Kamala Harris and Donald Trump?
Well, it's very interesting because we had a poll out over the weekend indicating that Donald Trump is ahead of Kamala Harris. But all of these polls in recent weeks have been within the margin of error of around 3 points. And, she did get an initial bump, it seems, when she became the candidate, a bit of momentum behind her, Joe Biden moving out of the way. Is some of that fading a little bit naturally after the initial kind of sense of excitement over that? We're going to see the debate really focus potentially on the economy, and that's where he does seem to poll better. She's a bit of an unknown when it comes to economic policy. She's starting to roll that out now, but obviously there are questions about what her economic policies would be. And so these polls are showing a little bit of uncertainty around that, but they're all, again, within the margin of error, just showing that this race is incredibly tight.
Yeah, and then the big debate, of course, is tomorrow night, September 10th. Ross, thank you so much, Rosalind Matheson. Now, it's also today a big day for Apple with the iPhone 16 16, the tech giant's first AI-focused smartphone, being unveiled later today. Now, Apple is also the focus of our Big Take, which looks at its rise to become the world's most valuable company. So let's bring in Matthew Bloxham. He's Senior Technology Analyst at Bloomberg Intelligence. Thank you for joining us, Matt. I mean, the Apple 16, is it going to trigger people kind of rushing to get the new version, or is it just another rollout?
I think it's probably going to be more of just another rollout. I think certainly back in June when they first announced the Apple Intelligence features, there's a lot of excitement. This was going to trigger a super cycle. I think there is a lot of pent-up demand out there, but what we've seen subsequently is a lot of these AI features are going to be drip-fed into the market, and a lot of the more substantial ones won't come until next year. So I think probably today's announcement is going to be a lot about the promise and potential of what this device is ultimately going to be able to deliver, but maybe the kind of fact that a lot of these kind of more exciting features won't come for a while may kind of hold people back a bit in terms of when they hit the buy button.
So Matt, what could we see in it? And again, I guess my gut feeling would be, let me wait for the second or third version because it improves. It just feels a little bit too soon to go out there and buy it.
Yeah, I think it's going to look very much like the iPhone 15. Probably the biggest differences physically are going to be a couple of new buttons. So there's the action button, which is already on a couple of the 15s, but all of them. And then this capture button, which is a bit like having, like when you kind of take a picture on a camera, it'd be a kind of quite clever and sensitive phone that allows you to kind of autofocus and move things and zoom in and out. So a couple of interesting physical features there. The rest of it's about the kind of the software upgrades. There's going to be a new version of Siri, which is going to be quite a big focus around the event, I think. And I'd say then beyond that, the promise of the AI features over the next months.
Yeah. What are the biggest threats to Apple going forward?
I think there's a couple really. But I think the most pressing, and we see it already, is the fact it's so big now that it's kind of under pressure to kind of break up, and the kind of value of their kind of integrated ecosystem under pressure. So they've got to navigate that carefully. I think beyond the immediate term, they'll see it's what comes after the smartphone eventually, and are they savvy enough to actually kind of be the leading player in whatever that new technology is.
Matt, thank you so much. As always, Matt Bloxham there from Bloomberg Intelligence. Coming up, we have a lot of things coming up today and tomorrow. We also have an exclusive interview with Pascal Soriot, the Chief Executive Officer of AstraZeneca. That's an exclusive at 9:10 a.m. UK time tomorrow. Up next, it's Bloomberg Brief, and this is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
The Fed debate continues. Futures rebound after jobs data showed a cooling labor market. The focus now shifts to CPI. Mounting fears, global growth concerns hit commodities and China. The CSI closes on the verge of a 5-year low. And former President Trump leads VP Harris in the latest poll, just days away from the first debate. Good morning, Manus.
Danny, good morning. It is about politics and the CPI this week. If the jobs data didn't give the narrative to the market that 50 basis points was assured, can the CPI really free the Fed to do 50 basis points? We'll debate that with Stephen Major in just a moment. Stocks redeeming themselves, down 4% last week. We went in at the start of the last week at record highs. We gave it back. The NASDAQ was pushed lower. The bond market, the very short end of the curve, down by 10 basis points on Friday. It was Waller's comments that really, I suppose, infected a whole new narrative, which is about being open to larger size cuts if that's what's necessary. And that really took hold both across bonds and equities. To the dollar this morning, you're looking at growth in Japan coming in lighter than the market had estimated, and that has interrupted the overall dollar-yen trade. You've got the dollar up by 0.7%. So we'll debate whether it's still good to be full bull on these bond markets with Stephen Major in just a moment. Danny, good morning.
Good morning, Manus. Well, as you're pointing out, it is a market that wants to interpret the data as negatively, be it stocks or bonds. The economist not necessarily seeing the same thing. Just looking through all the calls in my inbox this morning, Manus. RBC, the data's not bad enough to push the Fed to 50 basis points. Oppenheimer, the conditions don't warrant a dramatic move at 50 basis points. Deutsche Bank, 25 is more likely. Goldman Sachs, it's not enough for 50 basis point. Everyone is saying 25, perhaps except for Derek Halpenny of MUFG, who still thinks it's 50 basis points. Really looking forward to that conversation too, Manus.
Yeah, he's convinced that it's 50 basis points. And as I say, is the CPI really enough to free the Fed to do 50 basis points? I was quite surprised when I saw that this morning. But one thing for sure is we are shifting incrementally further away from the 1995 narrative, which is a perfect soft landing. And in a perfect soft landing, you got 75 to 125 basis points as being the rate cut corridor. And a lot of people are moving to a 200 basis point corridor or cycle.
Well, a lot of the thought is it really a bad world where you get 200 basis points, or is it just getting back to normal? And that's where the CPI idea comes in. This idea that CPI just needs to be cooler, and it just means the Fed needs to be not restrictive. Therefore, maybe 200 basis points makes sense. Well, in terms of this bond market, how bullish you want to be, you hinted at this, Manus. Stephen Major, global head of fixed income at HSBC, writing in, we think valuations are still attractive, with the Fed expected to start cutting rates at the next meeting. We think it's too early to pull our bullish horns in. I'm pleased to say Stephen joins us now. Steve, you've been right on this call. The market has moved towards you. You still see more bond strength to come. 3% is your call for the year end of next year. What gives you the chutzpah to hold on to that call, Steve?
Well, it's tempting after you've had a good run to maybe step back and cut the the duration back. But having looked at it more closely, Danny, we recall that most rate cycles see about 3% of cuts from the peak down to where they get to. And that's also, by the way, consistent with the Fed's own projections as to where longer run equilibrium is. So I think that looking for 3% of total cuts would be reasonable. And that says that maybe there's not enough in the price. That there's a third aspect to this, is that when you look at previous rate cycles, you learn that the time to start pulling back a bullish view is when there's an overshoot in the forwards. Now, intuitively, that overshoot isn't going to happen before the first rate cut. And empirically, so just looking at the data, the overshoots tend to happen a few cuts into the easing move. So we're not there yet.
So, Stephen, if the market is not overstretched and you look potentially for a 3% in cuts, where do you want to be on this curve? Is it squarely at the short end, or do you look towards the belly?
This bit's been tricky because we've preferred to just be outright long than to play steepening. The truth of it is it would have been best to do both because the curve has steepened from the front end. If you look at it today, I don't think I'd want to chase the steepening move. So in answer to your question, sitting in the belly has been a good stance. You're just being outright long is better than playing steepeners here.
But the front end of the curve, Stephen, as you point out in your research, is still deeply inverted, despite the rest of the curve uninverting. With something like more than 5% yields on a 3-month bill, and even if you get 100 basis points, that will still yield you more than where the 10-year yield is right now. What breaks this market's habit of just T-bill and chill?
Yeah. Well, what the real money buy and hold investors can do is go into credit, and I think that's what they've been doing all year long, taking the investment grade credit, going for the best quality they can. That helps to mitigate that negative carry and roll you get at the front end. I think that the alternative, if you're stuck being in the rates market, then you have to go to a longer position further up the curve, or you go and find surrogates, and you know, with a weaker dollar and a rallying treasury market, more and more people are looking at EM local rates, because again, you've got value there. So there are still things to do in fixed income, and it's not just a simple case of being long of treasuries.
One thing for sure is we're at some kind of a pivot point, regime change, structural move in risk. How do you look at it? You've had a couple of weeks away. How do you look at the shift in risk when this cutting cycle begins?
Yeah, so that's an interesting angle, because we know that whilst the cyclical side of the Fed's mandate tends to be inflation and employment, there's the other aspects too. They've got to look at the ordinary or the orderly functioning of the treasury market and financial stability. Now, once you start doing that, it's global, and it goes beyond the near-term cyclical patterns in the US. And here you've got to integrate what's happening in Europe, what's happening in China with their data, whether that feeds back into the US Fed's view. You've got to think about geopolitical risk. You've got all the saber rattling ahead of the US election. So it strikes me that you have to be fairly safe. And I was talking about credit. I said investment grade credit. I didn't say high yield. And I think that's where you're seeing some risk being taken off of the table. We're very late in the cycle, and the valuations on high yield look vulnerable to a correction.
Stephen, just to pick on the first part of what you said, do you think that there is an outside risk that you see instability in the treasury market, that you start to see some outside moves, whether prompted by global geopolitical or political events in the U.S. too?
Yeah, Danny, it is a great question. The thing is, we don't see them, and we're not forecasting them. But what we are conscious of is that previous cycles have been driven by events. So before COVID-19 hit the screens in 2020, the Fed was easing because of a repo squeeze and dysfunction in the treasury market on the back of the QT. And Every cycle, by the way, is like this. Manus mentioned 1995 as being a perfect soft landing. I would even question that. There was a Mexico default in 1994. So it strikes me that just about every cycle is explained by some kind of event, normally related to leverage, something exogenous, endogenous, and without knowing what it is, we have to be aware that it might happen. I'm sorry if that's not a perfect answer. It's just that it would be wrong if I knew what it was going to be, wouldn't it? Because I don't.
If life was perfect, Stephen, we'd all be doing something else on a beach, probably. But talking about exogenous shocks, many people have said to Danny and I, wave 2 of the yen carry trade, the structural unwind of the yen carry trade. Danny's a bit disparaging of it. I'm less disparaging of it. What do you say to that? Is there a second wave to really come?
Well, it looks obvious with hindsight that the dollar had become overextended at 160 or so. And it's one of those ones I look back at it and think, how did we miss this? It was so obvious. But of course, the carry trade, it isn't just those that have borrowed yen to buy US risk assets. There's also direct money flows by Japanese investors outright long, taking the currency risk. There's all kinds of ways this is expressed. It's through banks, it's through leverage trades, and it's through outright flows by real money investors. So I don't know how anyone could say for sure that that's over. It seems to me the amounts of money involved are just enormous. So I would probably err on the side of caution here and say it's very unlikely that this one's over.
Okay, a ways to go. Stephen, time to keep our bullish narrative in these markets, as you say. Stephen Major there at HSBC. Other stories trending on your Bloomberg terminal this Monday morning. Let's kick it off with Boeing. Its largest union said they've hammered out a landmark deal to potentially avoid a crippling strike. The troubled aircraft manufacturer offered a 25% pay increase over 4 years and a commitment to build Boeing's next plane in Seattle, according to separate statements from the two sides.
And Couche-Tard have told Seven & I that it wants to work together to agree on a friendly takeover of the Japanese convenience store operator. The move comes after Seven & I, which is open to a sale, pushed back on the Canadian company's initial proposal for being too low. Talks are set to intensify over what would be the biggest foreign takeover ever of a Japanese company.
Big Lots has filed for bankruptcy protection and is planning to sell the firm's assets and its ongoing businesses. It's in a court-supervised process. The Ohio-based discount retailer has agreed to sell the business to private equity investor Nexus Capital with assets and liabilities of $1 to $10 billion. That's listed in the court petition.
Now, coming up, former President Trump scores a narrow lead over VP Harris in the latest poll. We're going to count down to the first debate. We're going to have more on that for you next.
And Derek Halpenny of MUFG. He joins us to discuss the jumbo Fed rate cut next week. That is coming up on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Many countries are leaving the dollar. You're not going to leave the dollar with me. I'll say, you leave the dollar. You're not doing business with the United States because we're going to put 100% tariff on your goods.
Republican nominee Trump rallying the voters in Wisconsin as the former president and his opponent VP Harris gear up for their first debate on Tuesday. Now, this is the latest New York Times Siena College poll. It shows Trump leading Harris by 1 point. Amory Hordown joins us around the desk this morning. So this is a little bit of an awakener for Harris going into this debate tomorrow evening. What is she got to do? And what does this poll show us that she's got to do to convince America to vote for her?
Well, this poll shows, like all the rest have, that really this is a coin toss. This election is on a knife's edge. This is why the debate is arguably more important for Kamala Harris.
Okay.
You know, voters are still trying to understand who she is. When you look a little bit deeper into the poll, this is the stat that stands out. 28% of likely voters said they need to know more about Harris, while only 9% said they need to know more about the former President Donald Trump. So you already have your idea in your mind of who Donald Trump is. This is more of a high-stakes moment for Kamala Harris. And given the fact that she only sat for one interview so far, and this is thus far the only debate they're going to have, not a single other debate has been put on the calendar, this feels of more significance for her camp because voters are still trying to understand who she is. Another stat from this poll, more than 60% of likely voters said the next president should represent a major change from Biden, but only 25% said the vice president represented that change, while 53% said Trump did. So Trump is going to try to define her in this debate as being tethered to Biden. And she needs to do her best to try to talk about the wins that potentially the electorate likes from Biden, but also putting some serious distance between the man she currently works with.
I was going to say, does that mean that this debate is more about policy than past ones if she needs to define some sort of platform that does seem like a shift from Biden?
Well, look, that's what a lot of the electorate is yearning for when you look into these polls. The issue is a lot of the time what these debates become is about style, about viral moments, and less about policy.
What do you think tomorrow night brings? I mean, some people are sort of saying Harris will go on full-scale attack to irk Trump, to try and get him to go off script and, again, avoid that low-hanging fruit that we've heard so often he's avoided taking. He just goes off script. What is the strategy for tomorrow night?
Right,
what is a win?
That might be a lot harder, though, given the mics will be muted. This is something that the Harris team actually wanted to undo. They wanted the mics unmuted. She wanted to probably recreate that moment she had with Mike Pence during the VP debate of the prior election when she said, "I'm speaking." And that kind of went viral beside the fly on Mike Pence's head. But that might not be able to happen now because Trump is going to be muted. So if he was wanting to respond to her, he would have no choice.
Then he's a commensurate when it comes to TV moments.
Right, and we need to remember, this is, what, his 3, 4, 5, 6, 7th presidential debate? Doing the math in my head of all the ones he had against Hillary Clinton, against Joe Biden. One of them was axed because of COVID. And, of course, against Joe Biden in July, which we saw a major shift, an absolute shift, seismic shift in this election cycle. This is Kamala Harris's first presidential debate. Of course, she's been on in the primary stage. She's been on VP debates. This is her first presidential debate. And for some Americans, she's still widely unknown.
Yeah. Amory, I just want to get back to what we started with. Trump saying at the Wisconsin rally, you leave the dollar and you're not doing business with the United States. We're going to put 100% tariff on your goods. How should we understand that?
Well, we do know that Trump does lean into this idea of tariffs. It's an economic lever he loves to use. I spoke to someone over the weekend that's close to the former president and said what he is trying to go after is these countries that have a surplus with the United States that are shrinking their dollar reserves, i.e. China. But other countries that this individual says comes to mind are those in the BRICS and the Gulf as well. But a lot of the time, what I hear from individuals that talk to Trump when it comes to economic policy is Trump will start out with a very high bar, an opening salvo, and that is a place that he likes to negotiate from.
Fair enough. Anne-Marie, I know you've got another busy week ahead of you after many busy weeks. We appreciate your time this morning, Anne-Marie Horger there. Okay, coming up, we're going to have the latest data out of China showing growing concerns over deflation risks. We'll cover that for you next this morning on Bloomberg Brief.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning. It is your Bloomberg Brief on this Monday. I'm Danny Berger alongside Manus Cranny in New York. Let's get you some front page news. A look at what's making headlines around the world. And we start with the Wall Street Journal that Apple is putting all the chips on AI. They're going to have their new unveiling of the iPhone 16 today at the company's annual event. The company's new AI feature, Apple Intelligence, is expected to be at front and center as they try to court Manus Cranny to buy a new phone.
Are you going to upgrade?
No, I'm going to wait till my phone breaks. Yeah, until my phone breaks, I'm not buying a new one.
She's waiting until the very last moment. This is not the customer that Apple wants. I'll be in there like Flynn to get a new one. The FT leads with Mario Draghi calling for 800 billion euros worth of investment. Now, this is to boost the EU to compete globally. Draghi also called for the bloc to commit to regular issuance of common bonds to compete with China, and the U.S.
Speaking of China, this on the Bloomberg, China deflation risks are growing. Signs of economic weakness are mounting. The latest data showing that core CPI in China came in at the slowest since 2021. Now the calls yet again grow for greater efforts to boost household spending. For more on this, let's go to Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, just start with the data we got. What did it show?
Yes, it's sort of worrying, I think, many economists, that core CPI, as you say, coming in at the weakest in 3 years, broader CPI coming in slightly better, but still not managing to meet expectations, and largely off the basis that we saw food costs rise slightly last month because of poor weather. But there are concerns that we are sort of seeing a deepening deflationary cycle. So, weak corporate revenue spilling over into lower wages and therefore spilling over into weaker consumption. And if you look, in fact, at second quarter earnings, we see some of that reflected. About half of the companies met or beat their expectations, but predominantly on the basis of things like cost reductions, layoffs, ensuring shareholders are getting value, rather than seeing a sort of an increased bump up in that net revenue. So, i.e., there are lots of sort of warning signs for economists that consumption is really going to take a hit, and we may be entering the sort of weaker, deeper phase of deflation. The concern there for economists, of course, is that the longer we stay in deflationary territory, the harder it is for policymakers if and when they decide to lift China out of that, the more they will have to spend, the bigger the policy ask.
Well, this is when you begin to understand the differential between a Chinese consumer and a U.S. consumer. Yi Gang already saying, look, get out there and fight deflation. But this has a reverberation to the stock market at a 5-year low.
Yes, absolutely. A lot of weakness in the stock market. And I think, again, there's been this sort of cycle where we've seen a little bit of optimism over some amount of stimulus, say some of those housing measure supports. We're going to allow the government to buy unsold property, or we're going to allow this refinancing of mortgages. But then ultimately we don't see follow through. And I think the piecemeal nature of China's support so far for the economy has led to sort of this cycle of sort of slight peaks and then deeper troughs and slight peaks and deeper troughs. I think there is a lot of bearish investor sentiment, particularly around, as I mentioned, some of those earnings, a lot of bearish expectations and forecasts coming from companies themselves. And the other element that we haven't touched on is that sort of the key driver of China's economic growth engine at the moment, exports, also was, came in weaker last month as well. So we had that sort of sputtering in the one part of the economy that was holding up and holding some of that weight for other parts as well.
Okay, Rebecca, it certainly is reverberating not just in the equity market, but across the commodity complex as well. Rebecca Chung-Wilkins there on the very latest China data. Let's just leave you with a snapshot of what's going on in global commodities. You've got oil bouncing by 1.1%, despite Morgan Stanley cutting their price to $75. But look at that iron ore. It's hovering around a pretty tough level on that.
Yeah, we are rebounding this morning, but we did just come from a low in Brent crude, the lowest since December of 2021. Yeah. Okay, coming up, we're going to speak with Derek Halpenny of MUFG.
I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
The Fed debate continues. Futures rebound from a slump after the jobs data show a cooling of the labor market. The focus now shifts to CPI. Mounting fears, global growth concerns hit commodities and China. The CSI closes on the verge of a 5-year low. And former President Trump leads VP Harris in the latest poll, just days away from the first debate. It's a fun, stacked week from politics to inflation. Danny, good morning.
And in the meantime, equities are certainly living up to the reputation of September being a bad month. We attempt to rebound this morning, up 0.7% for your S&P 500 index. They fell every single day the holiday shortened week last week for the worst week since March of 2023. The SVB collapsed for tech stocks. It was their worst week since 2022. Meanwhile, two-year yields, they are up this morning 5 basis points, but around their lowest since 2022 as well. The yield curve uninverts to close on Friday. The first time we've closed at that level, at the longest yield curve inversion on record. The front end of the curve still not totally inverted when it comes to 3-month and 10-month. NYMEX crude, that also attempts a bounce this morning, about 1.25%, but still that also closed at its lowest level since 2022. Manus, it is a market that is trying to stage some sort of rebound, but is it of the dead cat variety?
Listen, all of these markets, all of these asset classes are desperately trying to put in a rebound. You've got the commodities on the rebound, oil on the rebound, Morgan Stanley cutting down their price on oil. But the question is on the bond market, Danny, and this is the interesting one that we've just had the conversation with Stephen Major over at HSBC, basically saying it's too soon to pull in your bullish horns. He thinks that there's more mileage to go in terms of the potential of rate cuts in this cycle, and so therefore he wants to be squarely positioned in bonds, really, rather than steepeners. I thought that was an interesting kind of nuance from him, but he's still full bull on this bond market.
Yeah, he says just own the curve, and I think that's a fair idea because so many people have gotten the steepener call wrong. It finally did happen. We finally uninverted. How much more steam does it have to go from here? But again, so much of the debate has been focusing on the magnitude 25 or 50, which of course is a important conversation. We're going to get to that. But Stephen Major's just very big picture. Look, when the Fed cuts, they usually do it by a large amount, and we want to position for that.
And then it goes back to the Fed speak that you had on Friday, which was from Waller, that's really lit it towards, I think, under the narrative about the ability to front load and go in size, go hard, go big and go early. But that's a debate. Will the CPI free us or free the Fed to go in a larger chunk and go 50 basis points? Derek Halpenny is the head of research at MUFG, and he weighs in on the impact of Friday's jobs report, writing this. While the payrolls report did not scream for a 50 basis point cut on September the 18th, MUFG House view remains that the FOMC will cut 50 basis points. Derek joins us now. Derek, good to have you with us. So the data didn't scream 50 basis points on Friday. The jobs data did not free the Fed. Why are you so convinced that they need to go 50, go in size, and go early?
Well, I think look, if you go back to the beginning of the global inflation shock, the Fed clearly got it wrong, as did most central banks. And I think they're going to be razor focused on making sure they don't make the same mistake again. In other words, being too late to start cutting. And I think going 25 basis points next week would certainly be a mistake. Now, I think given the market pricing where it is right now, if nothing changes, yeah, they'll probably do 25 rather than 50. But, if you consider, Danny mentioned the tech performance last week, and that was into a market in which the market was moving for more aggressive easing from the Fed. And the danger is that I think, as Chicago Fed President Goolsbee spoke about on Friday, is that if inflation expectations are coming down, and that's what's likely to happen in circumstances of weak equity markets, and look at what's happened in the commodity space, then you actually get a 25 basis point move, but then you get to the next meeting, and there's a potential that the real policy rate is actually tightened, or certainly there's been no real easing. So you need to get ahead of the curve. And when you look at the oil market, you look at the wholesale gasoline price, which is very important for inflation expectations in the US, they're coming down quite sharply. And I think in order to kind of, get ahead of the curve, they have ample ways to communicate. And I don't buy this argument that doing 50 is going to create panic and, make the scenario worse. I just don't agree with that. And I think Powell has every the platform in terms of the press conference to give a communication to ensure that doesn't happen.
Derek, from Fed speak, just to take you what we heard from Waller on Friday, he said that he expects cuts will be done carefully and they can act quickly and forcefully if subsequent data shows a significant deterioration in the labor market. That seems to suggest, and at least this is also the read from Goldman Sachs, that he's not ready to move 50, but would be should the data show it. Derek, if this current spat of data, to your point, isn't the one showing that they should go 50, what do you think the bar is? What would it take to convince the Fed that they should be moving in some size?
Well, obviously the window is pretty small now. There's only one important print, and that's obviously the CPI this week. Obviously, if that's an upside surprise, I think the chances of 50 basis points is certainly gone. But again, we still have the financial markets, and in terms of what I mentioned in the commodity space, in terms of increased volatility, in terms of the equity markets, and of course, Waller is obviously a senior member of the FOMC, but going back to Powell's speech in Jackson Hole, there was a real sense of anxiety on being behind the curve, and that the focus has suddenly shifted from upside inflation risks to downside growth risks and labor market weakness. So there was no period in between where the risks was becoming more balanced on both sides. So I think there has been a dramatic shift in the communications, admittedly on Friday, which I think is what's kind of shifted the market pricing today, was Waller's comments. But the bigger picture is still, I think, an FOMC that is very concerned and growing more concerned about labor market weakness, which net of revision on Friday, 56,000, was a pretty weak non-farm payrolls.
Given the weakness in the private payrolls as well, the 3-month average on the private payrolls is the worst, some say, since the GFC. And that validates the view they are behind the curve. How can they use the economic projections that we will get as a new arrow in the forward guidance? You say they have many tools at their disposal, but to what extent do we look at that?
Well, yeah, I think that is important. And if they do 25 and we're incorrect, I think certainly the communications, whatever the median dot profile is, I think the communications from Powell will certainly emphasize the flexibility of doing more, even though the median dot might not signal that. But I think the forecasts will be important because, of course, since the last forecast, we now know that there were 818,000 fewer jobs created as reported in the non-farm payrolls. So that means we're going to have a higher unemployment rate and a lower core PCE relative to the forecasts in June. Mm-hmm. So that definitely opens up the ability for Powell to be a lot more dovish and indicate that they can be wrong with their forecasts and they can do more if required.
elsewhere, Derek, you want to be short dollar yen. Mike Wilson of Morgan Stanley out with a note this morning saying that the unwind of the yen carry trade still has a risk to equity markets. How do you understand the yen, the carry trade, and its impact on specifically tech stocks in the U.S.?
Yeah, I think what I would describe as the fast money, if you look at the IMM data in terms of speculative leveraged positioning, there's been a substantial liquidation, but I still think there's more structural positions there that certainly still need to be unwound, and there has been a linkage with the tech sector. And I think even in the corporate space, there are companies out there with yen-denominated liabilities, and they haven't hedged that. Certainly not fully in order to take advantage of the beneficial funding costs. So now they're looking for dollar yen to go back up in order to increase their hedging and buying Japanese yen. So I think a market that was basically buy on dips for the last 2.5 years since the inflation shock began in March 2022 is now becoming a market of sell on rallies, because I think there's plenty of appetite out there for investors to either liquidate or to hedge by buying the Japanese yen.
Derek, I mean, a perfect encapsulation of markets over the past week where we sold on anything that looked like weakness. Derek, always appreciate your time, always wonderful. Derek Halpenny of MUFG. Okay, coming up, Treasury Secretary Yellen brushes off concerns over an economic hard landing.
I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're not seeing layoffs. We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs. unemployment insurance claims remain at very low levels. So I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
In a church in Austin, Texas, Treasury Secretary Yellen reiterating her confidence in the U.S. economy, sitting down with Bloomberg's David Gura over the weekend. And I'm pleased to say that David joins us now. David, we heard a little bit of it there, but a wide-ranging conversation. What were some of your takeaways?
We talked a lot about, this was the day after the jobs numbers, so she was keen to talk about her sense of the labor market directionally. She's a labor economist by training. We also talked about the work that she's done as kind of Treasury Secretary as diplomat. She's traveled to China and established this new conduit with her counterparts over there. Obviously has done a lot with Ukraine and Russia as well. And looked ahead to sort of what she hopes to accomplish in these last few months. I asked her kind of offhandedly, is there a world in which you might stay on this job past January 25th? She didn't dismiss that entirely, but she still has a very long to-do list of things she hopes to accomplish, and certainly financial regulation is something that's top of mind for her.
It's interesting that, you know, after that interview, and then you have Trump talking about 100% tariffs on anybody who tries to de-dollarize. And of course, there has been this move by China, a number of the other BRICS, to do that. What did you have to say about China?
You know, she feels like the relationship has been repaired somewhat, and that there is a means by which she can communicate with her counterparts more easily than she could before. But the dollar thing is so fascinating because she was on Capitol Hill just a couple of months ago, and a congressman asked her, what's the thing that keeps you up at night? And she talked about sanctions and the power of sanctions that she has and has deployed over these last few years. There is this fear that she has that the more that you do those, the more you might have countries kind of looking for other currencies as a way to avoid it, and that could weaken the dollar. So, not to say by any means that she and Donald Trump are on the same page, but you know what he's proposed is yet another tariff that if a country goes away from recognizing the dominance of the dollar, he would impose a massive tariff on it. So she also is thinking about that, the role of the dollar and the strength of the dollar. And that's in the context of China, of course, but of India and all these other countries around the world as well.
And David, you're also gearing up to cover the debate in Philadelphia, and we're getting to the point of Trump's new proposal. Things just kind of being thrown out there ahead of this. There was a recent New York Times Siena poll showing that the race has flipped is the wrong word. It's still extremely close, but Trump's slightly ahead. How does that set the stakes for tomorrow?
It will be so fascinating to see them on stage with one another. They haven't been in the same room together, which is just astonishing. So like the drama and pageantry of that will be so interesting to see. But this race is incredibly close. And I think the fear on the vice president's part is that maybe the campaign has stalled a little bit here. She had this momentum after she was named the nominee. Has it stalled? And so this is a huge opportunity for her, yes, to face her opponent directly, but also to introduce herself more fully to the American people. And when you look at kind of the intricacies of that New York Times Siena poll, there are a lot of people who say they know well Donald Trump and what he stands for and how he operates. She is still a bit more of an enigma, and this is a chance I think that they see to change that.
Yeah, 30% say that they need to know more from Harris. They know what Donald Trump is about. How difficult are the guardrails of the microphones being down? I mean, Newt Gingrich says basically she will try and irk him and then he will go off script, even though the mics are down. But how much of that is a restriction for her to flourish?
You know, you look back on the last big debate that she had, and that was against Mike Pence. She had that moment where she said, I'm speaking, when he kept interrupting her. And I think that the campaign would have liked to create the opportunity for another moment like that. They know that Donald Trump is likely to spout off and interrupt. The mics will be muted, and she won't have the chance to do that. But there's a lot of reporting that over the course of these last 4 or 5 days in Pittsburgh, where she's been preparing, there's been an effort to kind of find ways in which she could irk him or get him to do something spontaneous like that, where she might not have the moment for that line with a microphone that's muted, but might get him to kind of go off what they hope is a scripted a forum that he could be in.
And it's probably not lost on a lot of people that this is happening in Pennsylvania, a really important state for the two of them, the swing state. Does that color at all what they're going to say in trying to court that state specifically?
I think so. When you look at her travel after this debate, she's going to go down to my home state of North Carolina on Thursday, but then back to Pennsylvania after that. So both campaigns understand the gravity and importance of this state, which has gone back and forth over these last couple of presidential campaigns. She's spending an awful lot of time there. Her surrogates are there, but they're also in Michigan and Wisconsin and Georgia. So they're really identifying and really kind of flooding those swing states.
Look, we've got a flurry of sort of headline policy over the past 5 days, from taxation, capital gains, trying to sort of draw differentiation. And then you've got, you know, the U.S. Steel potential ruling from Biden on blocking that deal. What wins in Pennsylvania? What will she focus on? If it is going to be a Pennsylvania, focused on Pennsylvania, what is it that shifts the dial in that debate tomorrow night in that town.
I'll say very quickly, I tried to ask Secretary Yellen about this, and she wouldn't bite on
She wouldn't bite.
the U.S. steel thing. But obviously, that's a huge issue, and you have President Biden saying reportedly that he'll, veto that deal if it comes to his desk after it goes through the CFIUS review. But fundamentally, what people, especially in the western part of that state, care about are jobs and the longevity of that industry. And so I think by her saying the same thing, that she would scuttle the deal, she's trying to emphasize to them that, yes, this is an incredibly important and integral part to the manufacturing economy in this country. And that's the pitch that she and Donald Trump are going to be making, that there is a way in which that can continue. See what specifics we get on that front. But I think to your question, it's likely to be tailored to that audience in Pennsylvania during the debate.
David, great work over the weekend, and we look forward to your coverage over the next couple of days. David Gura there. And the ABC debate will be live on Bloomberg TV. Our special coverage starting at 8 p.m. Eastern on Tuesday evening. Don't miss it. It's a deep dive into the significance of the state of Pennsylvania for the race right here on Bloomberg Brief. Okay, let's have a quick check on a stock that we're keeping an eye on. It's Boeing. It reached an agreement with the union to avoid a strike, which could be yet another problem in a disastrous year for the plane maker. Let's get to Danny Lee. He's standing by with the details on this. Danny, good to have you with us. So it looks as if this is quite a considerable pay deal that's been done, but is it what the union started out? How good a deal is it for management relative to where they started?
Yeah, good morning, Manus and Danny. And so when you look at what's been put on offer, clearly Boeing and the IAM union leadership think it's a good enough offer. So we're looking at 25% over 4 years in terms of pay raises, a sweetener for the workers if they vote for this. It's an 11% pay increase immediately and a $3,000 bonus. But when you look at what has been put on overall, it's a 33% increase. It's still short of the 40% that the union had originally advocated for. So will this all work? I mean, Thursday is going to be the key crunch date for this vote, and it's the first time workers have voted in 16 years. But it's also on Thursday at midnight where if this vote doesn't go through, the workers do not back this, then we will potentially see a strike. Workers will actually have to vote twice, in fact, voting to whether to back Boeing's best and final offer and then whether to walk out on the job.
So there's still a lot of details to be understood about this, Danny, and we can get into those. But first, I really want to ask you about Starliner, about Boeing's spacecraft, that they managed to return to Earth without the astronauts, but they managed to return it to Earth over the weekend. Is there some sense that the wider narrative about Boeing is improving, or if not improving, at least sort of reaching a plateau?
Well, when you look at what Boeing has gone through over the past many months, frankly, I mean, even the fact that Starliner returned safely, the fact that it had an incident with the 737 MAX on Alaska Airlines at the start of the year, this door blowout, this really caused management upheaval, financial upheaval, and this critical vote on Thursday ultimately could mark a new low for Boeing if they lose this vote.
Well, two things are sure. They've got a debt load and a cash burn. How will the market, I mean, the market's bouncing on this morning in the first instance, the potential for this deal. How do you think that's going to play out on those two narratives? Stock's up 4.6% at the moment.
Yeah, I mean, you look at the stock, the pre-market move at the moment, and it's getting ever higher. But you just have to focus on the most important people at stake here. It's the workers, the noisiest people in the room, frankly. And when we saw this deal being unveiled overnight, the workers, if they are to be believed that they are the factory workers on the shop floor, they absolutely panned this deal. And so it'll be fascinating to see what happens on Thursday, the kind of vote that Boeing sees backing this deal. If there's very little support, do they have to go much further and potentially pay a lot more? Then there is also how many workers will support a workout, and they need a 2/3 majority. So it's clearly wait and see at the moment, but we're coming down to the crunch time.
Crunch time indeed. Danny, we appreciate you staying late for us. That is Bloomberg's Danny Lee. Okay, coming up, we're going to set up your week ahead, including the first debate between two presidential candidates, the first time they will be in a room together. CPI numbers also ahead this week. That to come.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's Bloomberg Brief. Danny Berger at Manus Cranny in New York. Let's get you set up for your trading week on Tuesday. Tomorrow, Vice President Harris and former President Trump will take the stage. It is their first debate. It will happen in Philadelphia. Wednesday, we get the big economic piece of the week. That's U.S. CPI, 0.2% month over month is what's expected for the month of August. And then on Thursday, an ECB rate decision that will be followed by a press conference from President Christine Lagarde. In the meantime, Manus, markets trying to fight back from the Friday moves.
Yeah, it is a fight back in the bond market. Short end of the curve, Danny, up by 5 basis points. Two-year paper down by 10 basis points on Friday. And really on that narrative from Waller, where he said, we require action and we're open to size cuts. And yet the conversation we've had this morning is going to be a debate whether the CPI frees the Fed. Here's one for you to think about. Does the CPI free the Fed the ability to actually go 50 basis points? I think that's a bit of a stretch.
Well, also the issue with Waller, even though he's saying, look, we're happy to front load cuts, he very specifically said that we would want to see more weakness in labor market data, hinting to this idea that they're not quite there yet. And that's why we've seen so many people come out and say the next move is 25. That's what they think the Fed will do. But as to what they should do, I mean, we heard from Derek Halpenny of MUFG, it will be a policy error if they don't go 50.
And he talks about the disinflation narrative in terms of looking at oil prices and gas prices here in the United States of America on the way down. And that to ignore those would be folly. And then Stephen Major says, look, it's just too soon to not be bullish. They're holding on to that narrative at the moment.
And if you're an equity investor, September has been living up to its moniker of one of the worst months. We try to rebound this morning. We'll see if it sticks. That's it for your brief surveillance. That's ahead.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
They need to gather in the room and think hard about, do we want to go towards 25 or 50?
I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case.
They don't want any more cooling in the labor market. So that's the argument for a 50 now. Quickly get us to neutral.
You cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Animal spirits are alive and well, and the Fed has to be careful about that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday on a 4-day losing streak on the S&P 500 following an indecisive jobs number on Friday, hoping to leave behind the worst week of the year so far on the S&P 500. Equity futures bouncing just a touch. On the S&P 500, positive by 0.7%. On the NASDAQ 100, positive 0.9%. This week, the focus shifts from one side of the mandate to the other. CPI and PPI, Lisa, just around the corner.
Key question to me is how much it matters. A lot of people saying the employment mandate very much front and center. However, I was thinking about this a lot over the weekend. Essentially, if we get a much softer than expected CPI print, how much does this open the door for the Fed to be even greater in terms of their accommodation, just simply because that is not a pressure still very much on the table?
The Fed goes into the quiet period now. No more Fed speak. Governor Waller closed that up on Friday. I still just think there's a little bit of daylight between where investors are and where Fed speakers are. And I think the way they look at the labor market is just a little bit different as well. For investors, I think they look at the labor market right now as guilty until proven innocent. And I think for officials on the FOMC, they see it as innocent until proven guilty, which is why the market's still at, say, let's go 50, we need to go 50. And market participants are looking at the Fed, who are basically telling them, I think the base case is still 25.
Basically across the board, every single note that I read over the weekend said 25 is the base case. But then when you look a little bit deeper, they're actually all saying the same thing, from Chris Waller to Seth Carpenter over at Morgan Stanley, which is the risks are skewed materially to the downside, and it just takes a little bit more information, to your point, to sort of prove the guiltiness of this labor market. And that is the feeling that you get. I do see some downside risk to employment that I'll be watching closely. Governor Waller, Seth Carpenter, our read of the jobs reports sees heightened risks that the slowdown will be more than our baseline assumes. That is the anxiety underpinning market movements.
So we've got CPI and PPI teeing us up for a Fed decision on September 18th. And then after September 18th, the only thing we'll be talking about is the election in early November. There is a big debate in the next 24 hours. We're all sitting here hoping we get some clarity on policy. Listening to the former President Donald Trump over the weekend, I have to say, I've got anything but clarity on policy. What's the new tariff push now? Have we got any detail on what that policy actually is?
Not a ton of detail, though I did speak to an individual close to the former president over the weekend about what he means when he says he's going to go after individuals who are basically not using the dollar. Basically those that have a trade surplus with the United States but are lessening their dollar holdings. They're trying to shrink their dollar holdings, i.e. China. Potentially they would use tariffs, or maybe other countries in the BRICS, or maybe some of those individuals in the Gulf. Donald Trump loves to use tariffs. He talked about this last week at the Economic Club of New York. It's one of those levers. Others I talked to about say that, Trump says he's going to use tariffs as a way to start the negotiating process. Maybe it's not going to be where it ends.
This highlights to me the confusion of what do you listen to. I'm old enough to remember when he was talking about the importance of not having a dollar that is too strong. And then you have this idea of people who move away from the dollar, which would allow it to be weaker, actually being persecuted, being tariffed 100%. This raises the question, what do you listen to? Which Donald Trump are we going to get? Which Donald Trump is the one who's trying to cater to the base that he's looking for? And to me, I think it's important to listen to the messaging. Right now, tariffs are taking the preeminence over the dollar. That might be the tone heading into some of these debates. And frankly, when I talk to businesses, they care about that more than most other things.
There's some contradictions we need to work through for the next hour, and we'll do our best to do so. If you are just joining us, welcome to the program. Equity futures on the S&P 500 with a bounce up by 0.75%. In the bond market, yields higher by 5 basis points on a 10-year, 375.51. We'll talk about what's happening with the yield curve as well. 2s versus 10s, the first positive close on the yield curve going back to 2022. And another bounce we need to focus on as well. Crude back at 68, up by 1%. On Friday, a 5-day losing streak. On Friday, we closed out the week. Lisa, down by almost 8% on WTI crude.
Going to the lowest level since 2021. To me, this raises a real question at a time where you're not just seeing it in the oil space, you're also seeing it in the copper, you're also seeing it in the iron ore. And to me, that's my big concern. At what point are we seeing demand rolling over? And we're seeing that from China. We're seeing that even Japan coming off just a little bit. What are the pillars holding up this economy?
Commodities have had a really, really tough time. Coming up on this program this hour, we'll catch up with Joe Quinlan of Maryland Bank of America Private Bank, ahead of CPI data this week. Congressman French Hill as Donald Trump doubles down on tariffs, and Neela Richardson of ADP on the American jobs market. We begin with our top story. Stocks looking to rebound after the S&P 500 suffered its worst week of 2024. Joe Quinlan of Maryland Bank of America Private Bank is still bullish. We maintain an overweight to equities with a preference for higher quality U.S. large and small caps. The productive capacity and wealth of the U.S. keeps us bullish on U.S. assets as core holdings. Joe kicks off the week with us right now. Joe, welcome back to the program. What I hear from you is you are unwilling to fade U.S. exceptionalism. Is that fair? And ultimately explain to us why.
That is fair, John, for sure. We are in the camp that we get 25 basis point cut in September, but really, the 50 or 25, that misses the point that this U.S. economy, most diverse dynamic in the world, you're seeing the demand for U.S. securities overseas. So, I know we get caught up in the moment, CPI, we've got the debate, we've got the election, but on the other side of the election, we're going to continue to grow. AI productivity is going to kick in, help drive the U.S. economy. So I wouldn't call it exceptionalism, so to speak, but when you look at relatively speaking, we're out in front, the United States. We see that continuing.
So, Joe, explain why the equity market is trading so poorly at the moment, worst week of the year. Explain why the dollar has been on such a losing streak over the last few months. What backs that up?
I mean, John, we know September is very rude to the markets, to investors. October will be choppy as well. So we've got some seasonality. We've got some pullback here with the mega tech. We're seeing a lot of our clients just happy in the money market funds. So we've got $6 trillion sitting there as well. I think the dollar weakness here a little bit, that's in and around investors, foreign investors, worried about what you just talked about, tariffs. What does that mean? What does it mean for more protectionism? So I think some of the foreign investors, remember, they own around 28% of U.S. treasuries. They own around 20% of equities. They have an indirect vote. So some of this dollar weakness, I think, is foreign investors repositioning ahead of a U.S. that's more nationalist and more protectionist.
We've heard a lot from people who say volatility is something you want to lean into and take advantage of because they have a bullish view, just like yourself, on the U.S. economy and U.S. exceptionalism. If that's the case, how much conviction do you have to lean against the sort of seasonal weakness that some people say we're seeing right now?
I mean, Lisa, we have high conviction. We put out a note, the CIO, on Friday saying on these pullbacks between now and the election, step in, buy the pullbacks. High quality, large cap, small cap, really all styles. So that's our preference, and that's our call. That we expect this volatility, right? If any investors in the market right now not expecting volatility, they're missing the opportunity to add quality to rebalance their portfolio. So we're leaning into the volatility.
Joe, what would you have to see in the economic data to confirm that, given the fact that you have Chris Waller coming out and saying, in general, they're still positive, but they do see risks to the downside? You're hearing similar types of commentary coming throughout Wall Street analysts.
Lisa, I see the economy slowing, not stalling. So 4.2% unemployment rate, that's pretty good, relatively speaking. We saw female participation rates all-time high. College-educated workers with a 4-year degree or more, the unemployment rate's 2.5. So we're still convinced that the consumer-led economy continues to chug along. It's slowing, not stalling. I think this is a head fake, the worries around the recession. Maybe we're going to have a recession someday, of course, down the road, for sure. We just don't think the markets right now needs to price that in.
Well, down the road, as in next year, and what pushes the U.S. into a recession?
Great question, Emery. What could push us into a recession? Suppose we have an election that is not settled by the end, say, November 5th. Suppose we have a pullback following that. So it's going to be a policy errors. Recessions come from policy errors. Think of it that way. So whether it's protectionism, whether it's the tariffs, whether it's immigration, whether it's overseas, some geopolitical event, that's how it's going to happen. So the recessions typically revolve around policy errors, and we think the Fed has done a good job. Remember, 2 years ago, we're talking about a CPI print coming down from 9%. Now we're below 3%. So we're not done. Maybe a lot of the markets are saying the Fed's behind the curve. We don't believe that, but recessions come from policy errors.
You mentioned protectionism a number of times and how potentially investors abroad are more worried about a more protectionist United States. Does that change whether we get Donald Trump or Kamala Harris?
Good question. We'll see. What you talked about earlier, the platforms. We need more policy meat on the bones here for investors to realize, okay, Democrats or Republicans. So yes, that is an ongoing issue with our clients. When you go out to talk to the manufacturers, you talk to a lot of small businesses, they are worried about the tariffs, protectionism. They're worried about trade relations, and I overlay that protection with immigration. That's a big point of contention for a lot of U.S. companies in terms of that's their key in terms of many cases for labor growth. So yes, protectionism is front in mind and the costs that are associated with. Protectionism typically is inflationary, and now we're moving to deflation that could reverse that policy where we're headed, and that could be upsetting to the markets.
Hey, Joe, we've got to leave it there. Joe Quinlan there of Maryland Bank of America Private Bank on this equity market. Still bullish, still long so-called U.S. exceptionalism. Jim Bianco of Bianco Research on with us a little bit later. In line with some of this thinking that we heard from Torsten Slock of Apollo on Friday following the number, which was basically head fake, nothing to see here. Things are okay in the labor market.
Saying that he's in the no landing camp, where basically the Fed doesn't need to do that much. Eddie Ardeni, who's also going to be on with us, a similar kind of tone. Question that I have is, when you talk about the balance of risks, and when you hear Joe Quinlan talking about a Fed mistake or a policy error, what is it? What is the more likely error? Them going by 50 basis points or them going by 25 basis points? Them moving more quickly and aggressively and allowing the market to rally, or them holding back? I don't think anyone knows the answer to that as much as people are sounding convicted.
Based on the price action in the bond market, it's pretty clear what the bond market expects.
Correct.
The big bull steepener, an aggressive move at the front end, right? A front loading at a series of rate cuts from the FOMC.
That's why I think this Wednesday is going to be really interesting. We have a CPI print that's coming out at a time when if inflation's coming in a lot lower, then that means, theoretically, if you extrapolate it out, this is a much more restrictive Federal Reserve. And maybe they have more room to cut rates without talking about this having to do with the labor market as much as the appropriate policy for this particular go-around.
For the first time in a long time, it really feels like September 18th. The next Fed decision is a game time decision. The committee really hasn't decided 25 or 50. I still say, and others have said this too, that Chairman Powell's speech at the end of August felt like a 50 basis point rate cut speech. FOMC officials since Chairman Powell in Jackson Hole haven't exactly backed that up.
No, in fact, 25 basis points seems about right. They talk about the soft landing. They talk about the need not to go too far. However, completely hedged, and I think this is important to note because Chris Waller really came out and talked about the even balance of risks, how they don't want to allow the economy to get too hot, but they're also very aware of the potential for downside risks. Really, it's a knife's edge. Not data point necessarily dependent, however, On the margins, data point dependent.
Bonds down, yields up by 5 across the yield curve this morning. Equity futures up by 0.8% as well. Let's take the opportunity to get you some stories from elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Venezuela's opposition leader Edmundo Gonzalez has been granted political asylum in Spain, fleeing to avoid arrest. A month ago, the opposition presented voting records they say prove Gonzalez won the July 28th presidential election. But Venezuelan authorities said Nicolas Maduro was reelected to a third term and ordered Gonzalez's arrest. Couche-Tard has reaffirmed its interest in 7 & I. The Japanese owner of 7-Eleven had rejected its $39 billion initial acquisition bid. Couche-Tard says it wants to work with 7 & I to agree on a friendly buyout. A deal would be the biggest ever foreign takeover of a Japanese company. And Boeing's Starliner spacecraft returned to Earth without its astronauts this weekend. The capsule left the International Space Station at 6:04 p.m. Eastern Friday night. It landed in White Sands, New Mexico after a 6-hour flight. The astronauts, Butch Wilmore and Suni Williams, were left behind. The pair were originally set to come home in the Starliner after 10 days, but will remain until February 2025 when a SpaceX craft will carry them home. And that's your brief, John.
Still shaking my head about this story. Danny, thank you. More from Danny in 30 minutes' time. Just shocking. Unbelievable.
She looked happy. She looked like she was having a good time in space.
I'm not sure when those pictures were taken.
Maybe it's really fun. You know, I've always wanted to have zero gravity.
You think those pictures were taken in the immediate aftermath of being told you're not coming back until February?
Maybe there are, issues.
Don't know about that.
You're right, correct.
Up next on the program, Donald Trump, the tariff man.
In the words of a very great but highly underrated president, William McKinley, I am a tariff man standing on a tariff platform.
That conversation up next from New York City this morning. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley. Live from New York City, welcome to the program. Your scores look like this Monday morning. Good morning to you. Equity futures positive.